everybody. Good morning. We're still on meet and greet this morning, I see. Good morning, everybody. I think they had too much fun last night. It's continuing, you see. Too much wine, too much food, too good a view, music. So are we doing simultaneous translation? I just don't see the booths, so I presume it's...
Yes, there is a
fine,
simultaneous translation.
Is the translation working, everybody? Yes. Do I get a resounding yes from the room?
Just give them a few seconds just to put mics on. The
mics on. No, headsets.
Headsets.
Everybody, is translation working? I don't think it is. Hello. Oh, well, they've gone quiet. But hi, can everybody hear me? Translation? Yes? Excellent. Very good. So good morning, everybody. Welcome to Vienna. I hope you all had a fun evening yesterday. Wine and food and song and music. So the team put on a good show for you all. So a very warm welcome to Vienna and to the inaugural event of the second phase of the PULSAR program. I really appreciate the fact that you've all taken the effort to come here. Great to have so many government delegations. I know you're all very busy people. And I'm sure that for all of you, November is probably in ministries of finance. Certainly when I've worked in ministries of finance, November and December were the terrible months of the year when everything has to get done. So I really appreciate you taking the time out to come to this event. Special thanks to our international partners and the speakers from many countries, ACCA, CIPFA, IPSASB. I see that they all sat at the same table. I think there's some sort of conspiracy going on between all the international organizations around standard setting. So very, very great thanks to all of you for coming. So why are we here? Well, the second phase of PULSAR has a clear objective, which is to promote the adoption and to strengthen the implementation of national accounting, financial reporting, and sustainability practices that are aligned with international standards and national development and sustainability needs. So there's a big theme around trying for all of us to reach a common goal of standards and in terms of comparability of quality of information in the public sector and the use of that information to serve our development purposes. And accounting and financial reporting are a core element of that. Often we tend to focus in development organizations on the first stage of planning and budgeting, but ultimately what drives the agenda is the accounting and financial reporting, because that's what generates the information for decision makers on what's actually happening on the ground. So in this session, we're going to be really focusing very much on the issue of what's been put in my notes as whole of government reporting. I think that's rather ambitious. I think a lot of countries are far away from actually delivering on whole of government reporting. I think what we're going to really focus on is on consolidation. And that's trying to build a common set of information across public sector entities using common standards for reporting and accounting. A lot of the focus today is going to be, and tomorrow is going to be on state-owned enterprises and subnational governments, both of which have tended in the past to operate as separate entities. And that's problematic for many reasons. No, for many of us, I mean, there's one element of the consolidation is around having a common standards for statistical reporting requirements, which is very important. I mean, we all have to submit our GFS information, but it's also critical for decision makers, for about how we budget. We need to know what all entities in government are spending their money on, and is that spending aligned with government objectives and policies. So that's critical for us to form coherent policies about how government operates as a unit, to make sure all of government is aligned. That's particularly important in areas such as sustainability, where it's very important to have accurate information on where each entity is trying to achieve and ensure that we're aligning our incentives and those incentives are leading to changes in government behavior. And probably most important, it's about risk management. Understanding what's happening in SOEs and subnational governments is absolutely critical for us to understand what the fiscal risks are for government. There are many contingent liabilities. I know that in this particular region in Europe and Central Asia, state-owned enterprises are very important drivers in the economy. They command the key sectors. They're also just a substantial part of the economy as a whole. And so inevitably, it's very important to have a handle in ministries of finance about how they're spending their resources and whether those resources are being spent in line with government policy. So whole of government reporting is going to be an essential part of the discussion over the next couple of days about tackling off-budget finances, how to ensure that we have complete asset registries, how we ensure consistency in valuations across government agencies, and also about how to highlight the risks of non-consolidated accounts and the benefits of unified reporting. Now, all of this inevitably brings us to the work of the EDUCOP, which is looking at how we build capacity across government. When we're talking about SNG, it's small subnational governments and government agencies, most of them will not have the level of skill that we find in ministries of finance, particularly around accounting and financial reporting. So it's really critical to think about how we build that cadre of skilled accounting and financial reporting professionals across the public sector. My first boss always told me, rubbish in, rubbish out. So your Ministry of Finance reporting is as good as the quality, the information you receive from your line agencies, from your subnational governments, and from your state-owned enterprises. So for a Ministry of Finance, it's absolutely critical to build capacity across the public sector. So hopefully we'll be able to look at some of the digital tools, how to set up a unified chart of accounts, how to build practical training for those of us across the public sector, and how to leverage both the FINCOP the teams and the EDUCOP teams. Another theme that we'll be addressing, perhaps not quite so much as we have in previous sessions, is around sustainability reporting. We've had a fantastic progress. IPSASB has come out with a new reporting standard. I think that's a milestone for all of us and a guide of how we're supposed to implement sustainability reporting across the public sector. This agenda is getting a little bashed at the moment. We've got the COP ongoing in Brazil, and we are way, way off track to achieve our sustainability goals at a planet level and at a country level. And I think it's beholden on all of us in ministries of finance to think a little bit about how we can use the power of the public purse to drive the sustainability agenda and at least provide information to our politicians about what the sustainability implications of policies are. Politicians in the end have to make the difficult trade-offs and decisions about how resources are used, but they can't make those decisions unless we have good sustainability information about how the public sector is operating. And it's absolutely fantastic that IPSASB has given us this tool to help us guide our way how to generate that kind of information for the public sector. And lastly, we're going to have a lot of discussions in the session about country-level technical assistance. Now, in the past, PULSAR has been a lot about these events. It's great. I'm getting to see all of you many times now, and it's obvious that there's a big family of public sector accounting professionals that come to these PULSAR events. And I think that's one of the strengths of the program is the peer learning and the sharing across the institutions. And we want to keep that going. So that's an important part for us in terms of how we manage the program going forward. But I think we also need to recognize that the donors, the generous donors, the Swiss Corporation and the Austrian Ministry of Finance, they've provided the funding that enables the program to continue through to 2028, end of 2028. And the reason they provide the funding is not for these events. These events are a means to an end, and what they're really looking for is reforms in the countries. So what they're asking for us to sort of focus on is country level results. And that's about how each of you go back from these events and you implement the discussions, the issues that have been discussed in your country contexts. So what reforms are implemented, and the program has been adjusted as well to think a little bit about how we shift the balance of resources. So there's going to be a lot more resources under PULSAR 2 for country level technical assistance. So that's going to be something that we're going to be discussing about how each of you works on a country reform program. And I think it's also, you know, the World Bank is one of many partners. Let's be humble. I mean, there's many institutions that play a role in how to build this capacity. Many of them are actually sitting around this table. So please talk to your colleagues on the table here, from IPSASB, from CIPFA, from ACCA, and other international organizations, our colleagues in the IMF, our colleagues in the Asian Development Bank, the European banks. These institutions all provide technical assistance on and can be used. So PULSAR is one part of the program in providing support for country reforms. We're delighted to help you in any way we can. We're great if we can collaborate with the other partner institutions around the world. So I'll end my introduction with a call to action. You know, please talk to each other. Please use this great opportunity to engage with your colleagues in other countries, learn, share your successes. There are lots of great successes. A lot of you have made a huge progress in recent years, and that's fantastic. We all know that there are a lot of challenges, so we need to think a little bit about how we address those, and being able to talk openly in this environment of professionals sharing the same agenda. Let's talk openly about the challenges that we all face and how we can address them. So learn from your peers, and then let's find out through these events how we can advance the consolidation agenda, what we can do, let's be realistic, what we can achieve, how we can improve our accounting practices and standards, and how we can build capacity. And with that, thank you. Thank you all for, as again, I'll repeat, thank you all for coming. I really do appreciate that. Thanks to our international organizations for being willing to participate and partner in this event. And thanks to our generous donors, Swiss Development Secretary for Economic Cooperation and the Austrian Ministry of Finance, who without their support, these kinds of events wouldn't be possible. So thank you all.
No, you can see as you wish. Yeah.
Okay.
Thank you very much, Adrian. Thank you for opening of our PULSAR 2 program. Friends, the positive is that, yes, we have confirmed program for PULSAR, public sector accounting and reporting. This remains to be a key reform agenda items for the WorldBank, for donors. While it's not a secret, many of our programs are facing some challenges with financing. PULSAR is fully funded program. For the next 5 years, we are fully funded, so we'll continue operation. As Adrian said, yes, we are going to have a different modality. If we have quite regular events, this kind, we will still continue, but at less extent. We're talking about a less frequency of gathering, at least once a year, potentially once a year, but the focus will be more on the country level. That's why on day 3, we planned next steps, and we would expect around the tables you discuss how PULSAR can help you on the country level activities and how we can advance. For that purpose, today, at the end of the day, we will share those country presentations, thinking where we always start supporting. Of course, it doesn't mean we need to immediately to move forward. We still have 5 years to go, but whenever you're ready, whenever your priority reforms are established, prioritization, you get leadership support, we are happy to support you for results. This time, as we discussed, we are going to talk about consolidation, exploring practical solutions for consolidation, and 2 elements heavily debated. Even yesterday, we debated within the WorldBank team and broader whether and how we do consolidation of SOEs, one topic. subnational government, municipalities, local government, another topic. And we have quite various countries which do different approaches, and we are going to explore together collectively to explore what are the good practices and how we each in every our country, what is applicable for our country case and how we move forward. This time we have in the room not only ministries of finance representatives who are, the majority of you are policymakers in IPSAS, in many cases IFRS as well, but we also have SOE oversight, the bodies representative. We try to invite one representative per country who represents the SOE performance monitoring function. So we connect those two functions together. So when we talk about SOEs, they are in the same room. On the municipalities, it was as part of the general government sector, you still are policymakers, so you cover local governments and subnational governments. And on behalf of our team, of Arun, Manuja, and me and all our team, we are very pleased just to welcome you in Vienna. And we are very pleased just to announce opening and continuation of our great program for results, for advancing accrual accounting, and for moving our reforms forward. Thank you very much. Now let's move to our first session and try to answer why consolidation matters. I'm very pleased to invite Thomas Müller, Markus Berger. By the way, as many of you know, Thomas has been selected as through very hard competitive process as the incoming chair of IPSAS board, which is a great news for all of us. Let's congratulate Thomas. But now he represents Accountancy Europe, and for this meeting, he will share his own views so far, probably, right? Yes, Ross Smith, IPSAS Board Technical Director, please join Ian Murray, Public Financial Management Head of PFM at CIPFA. We have Bernard Charles, who is a Senior Manager at PwC and leader of IPSAS reforms in Austria, and Guido Wick, who is the Estonian, our very strong reform champion.
So, ladies and gentlemen, very good morning from my side. I didn't know actually that I'm representing Accountancy Europe this morning, but as you see on my slides, it says something different, but that doesn't matter. I'm very flexible. So anyway, thank you very much for the invite. I can only echo Adrian's words about the value and the importance of these events as a platform for peer learning and exchange of experience. And as Adrian pointed out, the focus of phase 2 of PULSAR being promoting adoption and supporting implementation, I think that is very much aligned with IPSASB's strategy going forward, having exactly the same focus. So please be and rest assured that we as the IPSASB will support the program for the upcoming years. And if there's anything you want to talk about, please approach this table as you heard from Adrian. We are mingling all here and are happy to talk. So with that, let's jump into the subject for today and for this session. And actually, this is a very broad and very general question, why consolidation matters. And I thought, okay, what should I talk about as being the first of 5 speakers talking all about this same general question? So let me kind of do some general considerations and before I provide some examples to kind of showcase what I mean by that. And last but not least, then come to the conclusions. And actually, it is very funny because if we talk about consolidation, I think you can start very generic in thinking about what if kind of somebody provides resources to somebody else and actually kind of tries to achieve a specific target. So a resource provider asks management to do something. I think that is enabling by providing the resources, the management with the power to do action. It is very easy if you have to kind of like one-to-one situations. So one resource provider, one management, you can control this person very well. But if it is like multiple resource providers providing money to kind of multiple people being responsible, then I think you have a problem. And I think the problem is generally described normally as principal-agent dilemma, because you have information asymmetry, and that leads to an imbalance, right? And actually, I think this imbalance can only be balanced again by introducing accountability. And this is what normally you find in nearly every law and regulations, civil law. If somebody is kind of asked to do something, he has to be accountable for what he is doing. And I think having that in mind as a general consideration, then you can easily think about, okay, that applies if users provide money to an entity, and that makes that entity what we call in accounting terms a reporting entity. Why? Because it has to kind of present financial statements. And the financial statements actually are the instrument of accountability, kind of how it is applied, how it is made happen. So when we think about the general considerations and the objectives of financial reporting, not by accident, therefore, we define two objectives. One is accountability, kind of looking at the past spending of an entity. And the other one is support decision-making of resource providers, looking at future spending. And if you look at the conceptual framework of the IPSASB, you find exactly this described. So if we accept that as being true, then think about the parent entity. Again, being provided with the resources, but in this time saying, okay, I will use a subsidiary for my operations. Subsidiary, in accounting terms, we call that control. So if a parent entity controls a subsidiary, then of course something happens. And control, I think that's important to understand, control is not only the majority of shares. Control is also kind of reflected by having the ability to direct somebody's strategy and operations, and is also kind of reflected by being exposed to risks and rewards. And I think that is very important. In this situation, what happens is, as a consequence, an extended accountability of management. The idea behind that is who can direct others how to act must be held accountable for this as if it was his own action. In accounting, this is reflected by kind of creating what we call a group reporting entity. So this is what, and Ross will explain that later, what we call an economic entity. So it's not only the parent entity who has to report now, it's the whole kind of construct, as you see it, which now has to prepare consolidated financial statements. So now, kind of, why does consolidation matter actually? And I just want to kind of illustrate that using two examples. So imagine this situation as you can see it here, and imagine that outside the public sector, there's a bank providing a loan to a company. I see that very often in practice, that obviously government is very interested in this company becoming or getting money to fund its operations. For that reason, the government issues a guarantee to the bank that the loan is provided. What happens by that is the bank transfers the risk to the government, right? Of course, what we want to see when we look at the financial statements is that this risk is reflected in the financial statements. I think we are all happy with that. Why should that be different in a case where the government directs a state-owned entity to provide this guarantee to the bank? By that, the state-owned entity kind of receives the risk. So of course, what we want to see is this risk also being reflected in what we call the consolidated financial statements. And therefore, we need to create a reporting entity, including the state-owned entity, which bears the risks from the guarantee which the government has asked the state-owned entity to provide. So thinking back again, if somebody has the power to direct somebody else to act in a certain behavior or to act in a certain way, he has to be accountable for that as if it was his own operation or action. A second example, intra-group transactions. So imagine there is a state-owned entity, and between the government and the state-owned entity, there is a service contract. So the government provides services to the state-owned entity, and the state-owned entity pays for these services. Also a very common scenario, nothing crazy, right? So what happens? Actually, the government creates revenue and the state-owned entity has expenses. So what if we do not consolidate? So we just look at the government as a reporting entity. What happens? The published financial statements show the revenue, but nothing else. So for the user, it looks like the situation is better as it is, right? And that's not what we want to have. So what should be kind of the case, and this is why consolidation actually matters, is by creating a group reporting entity and by consolidation, which includes elimination of intercompany transactions, we eliminate revenues, we eliminate the expenses, and by that, we kind of prepare consolidated financial statements without impact on surplus and deficit of these intra-group transactions. And that is actually what we want. And a very important thing here, aggregation, meaning I'm writing all financial statements underneath each other, and then I kind of do a summary of that, is not providing this purpose, right? It's not eliminating intra-group transactions. So that brings me to the conclusions and to the end of my short presentation. So 4 things, actually. The first thing, the ability to work with third parties' money and decision-making power needs to be balanced by accountability. This general rule applies also to governments, working with taxpayers' money being accountable for their decisions. Very generic, but not very often accepted. Second, the power of a government to influence economic decisions and direct the operations of another entity extends its accountability beyond the legal boundaries of its own entity, e.g. the ministry, and this is what we call an economic entity, right? Third conclusion, consolidation breaks the legal boundaries of entities. So to provide resource providers with a holistic view, and we heard the term whole of government accounts, on the performance of the economic entity's transactions with the economic entity are and have to be eliminated. And last but not least, and we will talk about that later in the SOE session, actually that is leading over, having the power to influence the performance of the whole economic entity and being accountable for it requires sufficient detailed information to support decision-making of the parent entity of the government and strong governance mechanisms. So there needs to be preparation, there needs to be a frame for that, there needs to be instruments to kind of satisfy the accountability responsibilities. With that, thank you very much, and looking forward to the discussion.
Thomas. Thank you, Thomas, for representing MMB Consult and for just coming up with the bigger picture. Why do we need consolidation and potentially, and what is the benefits? Now let's hear from Ross. What is IPSAS board position? Why do we need consolidation of SOEs and subnational governments?
Thank you very much, Armin, and thank you for having me here today. I just wait a second for my slides and my timer to come up. While that's happening, one, I'll congratulate Thomas as well as appointment as the new IPSASB chair starting in January, and also for actually delivering a great presentation within time with a few minutes to spare. So very well done. I'm going to speak to you today about our IPSAS consolidation standards and just talk about a few misconceptions or misapplication of the principles. And in doing so, I'll speak to you about the foundational concepts behind consolidation in IPSAS. And I'll also just highlight again that in terms of our standards and how they work when it comes to consolidation, they are a set of principles. They're not rules. And the IPSASB as an international standard setter doesn't really have a position on how consolidation should be performed, but does have a group of standards that tell you how to assess key concepts that tell you your ability to influence the other entity's operations, as Thomas just explained very well with his examples on the reporting entity and how to assess control, and what the accounting outcome is from the perspective of whether that control leads to accountability and rights and obligations that the controlling entity should reflect in its financial statements. So I won't go through all the points in this slide, but the purpose of this slide is to outline that within the IPSAS standards, there are a suite of standards that tell you how to account for interests in other entities. And the key element of how to determine the appropriate accounting of your interest in other entities is the degree of control that you can influence on that other entity. And again, as Thomas highlighted very well in the previous presentation, the level of accountability that you should have based on that arrangement. So at the top of the slide is IPSAS 35, and that's where you have full control. And when you have full control, that means you can completely direct the activities of the controlled entity in all respects. It also means you're completely exposed to the liabilities and guarantees that you provide. And therefore, the accounting outcome in that sense that's laid out in IPSAS is line-by-line consolidation, so that the entity should account for line by line the assets, the liabilities, the equity investment in, as well as the revenue and expenses of that controlled entity as a single economic entity, as Thomas just showed on his slide, where you eliminate intercompany transactions and balances so that you get a single picture of the financial picture of those combined entities. And again, that's because you have control that leads to influence and accountability to the resource providers. And as you move down, you have different levels of control. So joint control, which is IPSAS 37 and a portion of IPSAS 36, is where you have two or more entities agreeing through an arrangement to jointly control an operation or assets. And in that sense, the control leads to either equity method accounting or proportionate pickup of assets and liabilities, revenue and expense, not line-by-line consolidation, slightly different, which again reflects the arrangement that's been agreed to and the accounting outcome depending on the nature of that arrangement. And again, from an accounting perspective in IPSAS, you would assess each arrangement, each activity to determine whether you have joint control and then the nature of that joint control, either as a joint venture or joint operation. And then further down, as the influence decreases, you have different accounting outcomes. So significant influence, where you have the power to participate and influence the financial and operating policy decisions, but not directly control them. You can do equity method accounting, which is kind of a one-line consolidation, where you pick up your change in the investment based on the operations that you control and their year-to-year operating outcomes. And again, in that sense, you get less transparency into the activities of the entity that you influence. And because you don't control it, that shouldn't be reflected fully in the financial statements. I'll just note here that the equity method is one method that we see applied to situations of control on a regular basis because it's a more simplistic accounting technique, but it also introduces significant lack of transparency. And I'll use an example from my home country on this one. Canada, the national standards do use equity consolidation as a practical expedient for consolidation, even when you have full control, because they do not want to align the accounting policies of the entities from the lower level to the higher level. But I'll give you an example. In the province I'm from in Ontario, they have a state-owned enterprise that has 18 nuclear power plants included in those state-owned enterprises. And those nuclear power plants and the companies that operate them that are fully controlled by the provincial government in Ontario have significant liabilities as well as decommissioning provisions. So year to year, they're actually making a profit today. But further down the line, there's significant liabilities that need to be settled. None of those liabilities are reflected on the parent company financial statements. There's a significant lack of transparency and a significant lack of accountability in the province of Ontario about how those future liabilities are going to be settled. And the government goes around telling people that from a debt sustainability perspective that they don't have a problem, but they do have significant liabilities at the subnational level, as well as in the state-owned enterprises from situations like that. And because of the lack of transparency, the national accounting rules allow in Canada. So with that being said, I'm telling you all the reasons why consolidation is important and why the standards are the way they are. But I don't want to understate it's a difficult exercise. It's not an easy undertaking, specifically in the public sector, when the scale of consolidation can be quite large, as well as even simple things that I've just talked about, determining control can be difficult to understand. For example, to do a consolidation properly, you do need detailed accounting data, both the parent and the controlled entity. That being said, in this day and age where we're getting more and more sophisticated IT resources available, and the cost of those resources continue to come down, and the scope of countries that are starting to use more sophisticated resources for consolidation goes up, I think we're in a better place than ever to use IT systems to our advantage to make something as complicated as consolidation a little more practical and a little more built into the systems, for example. And you can do that through a number of ways. One, having a consolidation system, a unified chart of accounts where you can tag intercompany balances and intercompany transactions as they occur, which makes it easy at the end of the year when you have to make your intercompany adjustments. Another area that's quite challenging in consolidation is to do consolidation properly. You need to materially align the parent company and the subsidiary company or subsidiary operations accounting policies. Now, with a little bit of planning, that's not all that hard to do, but you do need to actually put some thought into that when you first select accounting policies in IPSAS to make sure that, you know, where you need to align principally, that you're kind of considering in the same manner the accounting policies as they're being set. This can't be understated. The next point I want to make here is you will need to apply judgment. There aren't hard and fast rules in IPSAS, and that's so that various different organizations around the world can use the same concepts and principles to determine their accounting outcomes, but you will need to apply judgment. There are practical ways you can help make that judgment easier. So you can develop on a national level or even subnational level accounting policies based on the IPSAS guidance that are more prescriptive on when you have control, how to set up the accounting system, that sit underneath the standard. So they wouldn't be not in line with the standard, very much in line with the standard, that help you be more prescriptive on what the accounting policy should be around something as important as consolidation and interests in other entities. And lastly, I'd say it's not impossible. Some countries do it. Some countries do it very well. Some countries don't. It's usually what we see with countries adopting the standards. It's the last area that's addressed in an accounting exercise. So don't underestimate it. It is very important. And I did want to, and I've only got 3 minutes left, so I'm going to run through these next slides relatively quickly, because what we do see when countries or jurisdictions decide not to use the control principles in IPSAS is they kind of take a blend of other frameworks, other ideas, and try and apply that in terms of kind of a proxy for consolidation. And I do think that's, you know, understand it from a practical perspective, but I do think it can be dangerous. So aggregation is one thing we've seen from time to time. And I kind of see that as kind of part consolidation. It's kind of adding up the balances, but it's not doing the very important part of aligning the accounting policies and then removing the intercompany transactions. And in some frameworks, such as statistical frameworks, aggregation is a perfectly appropriate framework because the purpose of those frameworks is quite different than what you're trying to do with consolidation and have that single financial view. So I'm not going to go through all these points because I think what they get to is the point that was made by Thomas quite well. But I did want to just put up these different frameworks, and I won't run through them, but happy to have a discussion after the fact. But each of these frameworks on the slides has a slightly different objective of the framework. And to realize the objectives of the various frameworks, you need to properly do the key concepts in that framework. And a key concept of IPSAS is very much consolidation as your final step in a full accrual accounting transition. And that gives you information that's very useful for accountability, decision-making, and a very comprehensive view of the finances, the assets that are controlled, the risks and liabilities that you're exposed to. So if you really want to realize the real value of accrual of accounting, don't underappreciate the ability that you need to take that final step at some point and get to consolidation. And I do agree with a point that Adrian made in his opening comments. Whole of government accounts, in my view, shouldn't be the goal. You really need to look at your local institutional setups and the levels of control, because it's not always whole of government account where consolidation is most important. It very much depends on the structure of your institutions, the nature of the control arrangements that exist. And I can tell you that in Canada, this idea of whole of government accounts for the Canadian government doesn't really work because we have 13 sovereign governments in Canada that have their own consolidations they have to complete because even the federal government doesn't control the subnational levels of government. So it is very complicated. And the last point I want to use is just a picture. Is the benefits of consolidation is it does provide the comprehensive picture of financial position and financial performance for the entire reporting entity from for the public sector from an economic perspective. So if you want that clear view of the finances, you really do need to think about consolidation and build that into your processes. So with that, close my presentation. Thank you.
Thank you very much, Ross, for this blurring and clear view of consolidation and the IPSAS perspective why and consolidation matters. Now let's move to Ian, just to Director of PFM, Public Financial Management at CIPFA, to hear also UK experience. And in the panel, we have different experiences, and UK one of the most advanced. Please.
Thank you. Thank you. I'll just wait for my slides to appear. But whilst I do that, I just wanted to thank WorldBank for inviting us here today. This is the third time I've had an opportunity to come to one of the PULSAR sessions. And as I said to a number of people yesterday evening, I always feel that I take away more than I bring. So I'll try and bring something to the session, but I'm really interested to hear the experiences that you're all having. So there are some familiar faces in the audience, but for those who don't know, I'm Ian Murray and I'm the Director of Public Financial Management at CIPFA. And CIPFA is the Chartered Institute of Public Finance and Accountancy, which is why we shorten it to CIPFA. We're a UK-based body, but we work globally, and we're the only professional accounting organisation dedicated to public financial management. So it's a real privilege to be here today. Local government in the UK is where we come from. That's our base. We work now across all strands of government in very different parts of the world. But I was going to focus on the thing that probably is closest to our heart and our history, and that's the experience of consolidation from a local government perspective in the UK. And we have sort of three principal concerns, I suppose, at CIPFA. So the first of those is that we have a role as the standard setter for local government in the UK. So we set a number of standards, but amongst those is the accounting code. So we set the financial reporting requirements. We also have a role as the professional body for many members working in both local government, but also other strands of government. So we have a responsibility to them. And one of the key things that we're passionate about at CIPFA is is making sure that it's that practical support. So it's how do you provide the on-the-ground practical support to practitioners and preparers so that you can make a reality of all of this. So I was going to start at a high level, and then I'll make some points about local government towards the end of my presentation. So whole of government accounts, we've been doing this in the UK for a little while now. So the first set of whole of government accounts was for the year ended March 2010. And I think we're held up as an example, and I think it is a success story, but it's a success story with a number of twists and turns along the way. But as a quick summary, the initial whole of government accounts consolidated 1,500 entities, and that included NHS bodies, that includes central government bodies and local government bodies. And what we found is that the WGA, whole of government accounts, has been a really powerful tool for a number of reasons. So it has increased parliamentary scrutiny of public money. Being able to provide that balance sheet view of UK PLC is a really powerful tool in those contexts. And so through a scrutiny window, it gives parliamentarians something that they can challenge both the government of the day and senior civil servants about in terms of the financial stability and the fiscal outcomes within the country. We've seen it providing that long-term view, so you can take a view about increasingly take a view about long-term fiscal sustainability. But we've also seen academics using it extensively to look at topics such as intergenerational fairness and any number of different perspectives. So we see it as something which is generally a power for good. And we can see a number of benefits coming as a result of it. And increasingly, it is seen as a long-term strategic tool. So that was 2010. If we move on to the year ended March 2023, so this is the latest set of audited whole of government accounts that we have in the UK. And I think the picture is maybe slightly different. So the scope of our whole of government consolidation has increased incredibly, actually, over that sort of 13-year period. There are now 10,000 bodies who are consolidated into that whole of government picture, and that includes public corporations such as the BBC and the Bank of England. So the scope of what we're trying to consolidate in the UK has increased over time, and as a result, the complexity has increased as well. And I think this is one of the challenges that we face. And with that complexity comes a number of issues. There are issues around data quality. So I think, I can't remember who said it, but I think maybe Adrian said that you're dependent on the quality of the data in those line agencies to be able to do the consolidation. And that's certainly a challenge that we see in the UK now that we're trying to do this at such scale. With that comes issues around timeliness. So where are we now? We're November 2025, and the latest set of accounts we have is 31st of March 2023. So I think that's, there's obviously some issues there, and increasingly a challenge around how do we integrate what's going on in that WGA space with policy making. The other thing that we've also had is that this set of accounts received a disclaimed opinion from our National Audit Office, and that's linked again to some data quality issues. So why is it that just to explore some of that complexity, and particularly from a local government perspective. So one of the issues or one of the challenges we have is that we don't have full alignment around financial reporting requirements. We don't use IPSAS in the UK. We use IFRS adapted for the public sector. Ross, I can look Ross in the eye and say that we do have quite high IPSAS compliance as a result, but we don't actually use the standards. And what we have, and this is an oversimplification, but we have at central government, we have a financial reporting manual. All of our central government bodies use that for their accounting. As an example, then the group accounting manual used by our health bodies, that's very closely aligned to the FREM, to the financial reporting manual. But off to the right-hand side there, we have our local authority accounting requirements. And whilst they follow IFRS and there's broad alignment, there isn't absolute alignment. And this is one of the things that creates challenges when it comes to consolidation. And largely that's about two things. So one of those things is prepare a burden. So obviously, if you're having to prepare your financial statements on one basis, but you're then having to adapt those financial statements as part of the consolidation process, that adds time and complexity. We've experienced this at the same time as we've seen, frankly, huge capacity and capability challenges in the local authority sector. We've seen reductions in funding, which just means that it's much harder for us to compete with other bodies, including the private sector, in that battle for talented public finance professionals. And then the other thing that really impacts in a local government setting is the role of funding and legislation. So in a number of key areas, the funding requirements for local authorities and the legal requirements placed on local authorities cut across the accounting requirements. And just to give a few examples of how that plays out, an example would be that depreciation is reversed in local authority accounts in the UK and is replaced by a statutory charge. So that obviously creates complexity on consolidation. Pensions we account for on the basis of IAS 19, so we do defined benefit contributions, but those get stripped out and replaced with the cash contributions. So we move from accruals back to cash accounting, if you like. And we've also seen the use of what we call statutory overrides, so this interplay between legislation and accounting requirements to either delay the impact of some financial reporting standards. So, for example, we delayed the impact of IFRS 16 on leases in local government, and it's been used in a number of cases to delay the impact of IFRS 9 and for some financial instruments. But we've also seen it, and I'm amongst friends here, so I'll say the word misused by politicians to buy space. And so a very real example that we're experiencing of that at the moment is that we have some services which are funded and run at quite large deficits. These are statutory services that local bodies have no choice but to provide. And using this mechanism, government has effectively allowed the treatment of a usable reserve, a negative usable reserve, to be treated as an unusable reserve. And for me, this is why consolidation absolutely matters, because if we do consolidation on that line-by-line basis, what we allow to happen is to flush out these issues. So they're not squirreled away, they're not hidden in the bottom half of balance sheets in 330 bodies across the country. They're consolidated into, on that line-by-line basis, and you can have transparency and, most importantly, accountability around some of these really, really pressing issues. So I think what we would say in the UK is that we've obviously been doing it for a very long time. I think we would see it as a success story. It's never been easy. As we've expanded, it's become more and more complicated. It's never done. You always have to come back and keep revisiting the processes that you have in place. You have to evolve, you have to iterate. But we do see it as a really, really powerful and important tool, not just because of how it can be used from a sort of a long-term strategic planning perspective, but also that transparency and accountability angle, which I think is absolutely key when we're talking about the use of public money. And I'm going to pause there and allow time for others to speak and for you to ask us some questions. Thank you very much for listening.
Many thanks, Ian, for bringing in one of the most advanced systems and still sharing the insights, and we'll discuss it. Then let's move to Bernard. Please give us insight one, why consolidation matters.
Very happy to do so. And thanks for having me again. It's always a big pleasure. And it's a particular pleasure to speak after such a series of excellent presentations, because I do not have to talk about the concepts and what the literature says, the theoretical elements and benefits of consolidation. And when Arman asked me whether I can do an input on why consolidation matters from an Austrian perspective, I hesitated a bit, because I have to plead guilty to what Ross said, having a practice of doing actually an equity consolidation when you control entities, because that's the common practice in Austria. So you have one line, the equity position, you put into your balance sheet, and you're going to see the deviation, right? So there's two options, either it goes up or it goes down. But basically you do not really see why. So I thought, what would be the difference actually if we wouldn't do that? And if we would do this kind of line by line consolidation, and this is what I want to show and demonstrate to you today. So I'm not going to talk a lot about the literature and what, you know, the theoretical benefits are, because I think this has been presented really excellently by the speakers before. So I will maybe just set up the scene a bit to say what we have been doing now to practically demonstrate the benefit of consolidation is that we, my team and I, we did a desktop exercise. So we took the financial statement of the government, we took the financial statements of the 7 largest SOEs, and we started to look at the accounts and see whether we find something to aggregate or to consolidate. And this is exactly what came up as a picture. And I'm not sure how well you can see it on the slide, so hopefully it works. But you can see, for example, that the total assets really increased, right? So it went from 130 billion to 219 billion. So that's roughly 90 billion out of sight, out of mind, if you don't do the consolidation properly. What we also have seen, and this was not a huge surprise, is that we've seen the share of property, plant, and equipment going up. Because some of the entities we consolidated was the railway company, the highway company, the real estate agency. So that makes a whole lot of sense. What kind of really took us by surprise was the amount of financial assets that came into the accounts. And this has not been, you know, financial markets deposits or any investments. This has been the real estate agency and the railway company nominating their real estate as a financial asset. So from their perspective, the only purpose they're holding those assets is to earn money. And it might make sense from an SOE perspective. But the big question is, does it make sense from a government perspective? So that's something you wouldn't come across if you don't start consolidation. Another big one actually was that we actually really didn't have any significant intangible assets. So Austrian practice is that if you acquire some piece of software as an intangible asset, you might recognize, but actually the other ones, the self-developed ones, are getting expensed at the moment. So now we had a huge chunk coming in of an intangible asset, which is basically that the government granted the right to collect tolls to the highway company. And again, from their perspective, that's an intangible asset. But from a government perspective, it might be not. But if it's not an intangible asset, what actually is it? Right? So probably it's PPE again. So you can see those questions only arise once you start doing consolidation. And another one was really subnational governments. So in Austria, almost exclusively the federal level can access the capital markets. And what they do from time to time is when there is demand in local governments, when there is demand in SOEs, they might do a specialized financing agreement where they collect some money from the capital markets, they hand it through to the SOE, they hand it through to the local municipalities. But what you actually are not seeing is that there is an inherent financial risk, right? So there is a receivable the government has to collect from the SOEs and from the local municipalities. Without consolidation, you're not really looking at the asset side of those things. So we didn't have this proper perspective in that case. And the last point I want to highlight also was that you get good insight into your own accounting practices. So when we looked at the Federal Real Estate Agency, we realized they had quite significant long-term receivables toward the government, but we didn't have the respective long-term liabilities in the government entities. Also, the government entities did not recognize their right of use assets for those long-term lease agreements, right? So you see some inconsistencies in practices, also in the area of taxes and taxation, right? All of those SOEs, they have to pay tax under IFRS. They're going to accrue for those taxes according to the standards, and you don't see any reflecting accounting treatment, let's say, in the government statement. So that also might be an interesting point to watch. One thing I want to mention really is that it was extremely helpful that all of those big SOEs, they used IFRS. And IFRS has a standard which is called related party transactions. And since they are owned by the government and they work with the government, they all had significant notes about the transactions they had with the government, which made it really easy to do the consolidation piece of the elimination. So that's something I just wanted to stress. So let's go to the other side of the balance sheet. And you will see actually in terms of shares, it didn't move a lot. So the financing structure of the SOEs was quite comparable to the federal government. A lot of long-term financial liabilities, some long-term receivables as well, but not a lot of movement. But you could see, for example, and I think this has been touched upon by other speakers, right? If you're not looking at the SOE sector, you are missing about 50 billion of debt, right? So, and again, we have the benefit of statistics, so we're gonna have those numbers there. But from a management perspective, and this is, Thomas, the point you made, right? You had and mandated someone to perform a task, and they might incur a risk doing that task. And this is what really becomes apparent when you start doing those elements. I mean, what you also could see is all of those companies are doing provisions for their pension obligations. At the current situation in Austria, the government does not, because we did at the time decide not to follow the IPSAS on the employee benefits, right? So you see those mismatches. They really come up once you start applying consolidation on a very high level, right? So I mean, neither Ross as a standard setter nor Thomas as his auditor would call this a proper consolidation, right? But you can see with a couple of days' work, you already get significant interesting information, and it really changes how you're going to see reality quite quickly. So just as one example, picking out the infrastructure, the PPE, we've seen it increase significantly in share, in size, so roughly 40 billion. And now the big question comes in, as the parent entity, is it PPE, is it infrastructure, or is it a financial asset, as the SOEs indicated? Because it really depends on how you're going to test whether you have the right amounts in the accounts, right? In the first one, you would more go for service potential and the question on technical feasibility. In the latter one, you only would ask the question, will I be able to collect the money? So very different approach, and it really makes a difference. And just touching on the profits and loss statement, because I haven't put that on the slides, but you could see since the infrastructure assets increased, that the depreciation that was shown in the profit and loss statement tripled. So it went up by 1.5 billion. So whether you're asking yourself whether you're investing enough and you only look at your own accounts, you're probably not going to get the answer. And what is the depreciation, the investment in the SOE? Probably it's a transfer in many, many ways. So that's really an important element. And again, the last point really I want to stress is that, you know, this is not bad intention. It's just that probably at some point the government said, dear real estate agency, we want you to follow economic principles, right? And they took that mandate and they started implementing that mandate. But you haven't touched point ever since, right? So they kind of went with that mandate and tried to improve it. But if you do not consolidate, you don't have a regular touch point on, are you following my policy, right? So that's an important point I want to stress. So in closing, I think, honestly, it is impossible to have a consistent fiscal policy and risk management if you do not have a consolidated view. And we can debate on whether that's going to be by applying the consolidation standard or whether there are other means. And what really showed our practical exercise is there are issues that only come up, really only come up when you do consolidation. And I have two quotes I want to share with you. One I really like of Lord John Maynard Keynes, who famously said, it's better to be roughly right than precisely wrong. So do not be afraid that maybe there might be room for improvement in the first steps you might take. And the second one is from Benjamin Franklin, who obviously was not a big fan of principal agent elements, because he said, if you want to get something done, go. If not, send. I just want to highlight that he then went on to constitute a representative democracy. So he might have resolved some of his issues with principal agents' concerns by governments. And I think that's exactly what we should do. So thank you for your attention, and happy also for the discussion.
Many thanks, Ross. Many thanks for bringing Austrian experience and telling that it's better to do to avoid being precisely better to be precisely more or less good, roughly accurate than precisely wrong. And also just very interesting that it's not only about liabilities, that you have 50 billion euros increase in liabilities when you consider discovered, and depreciation of 340% increase in depreciation. So it means that there is missing a lot of information for decision making and accountability. But also you brought an interesting point of 61% more assets which are missing if you do not consolidate. So both assets and liabilities are missing in revenues. So now let's move to Estonia. Guido is going to share how Estonia does and why consolidation matters in Estonian case. And then we will move with the questions and discussion. Guido has also a small video to share, so that's he's connecting his computer as well.
Can I change the screen? Yes, not yet. Yeah, no. If you don't, then this is your slide. Yeah. Can I put the laptop on the screen, please? Oh, sorry. Now I have, yeah. Now I have.
Again, please.
Yes. Yes. Okay. It's not from the beginning.
Okay.
But not there. Mm-hmm. Oh, now we're here. Okay. Oh. Mm-hmm. So, morning. This is should be a practical exercise. So maybe to start, I will give you as a practitioner from financial management throughout my life, view from there. So maybe as a topic of this presentation is why consolidation matters. So I'll try to answer it more simply and hands in hand, the hands-on kind of perspective. The very purpose of why we do what we do in financial reporting is to give financial information from the past, about the entity that we are reporting on, that we are managing, and the information that is useful when we make management decisions about the future of that entity. So we reflect, describe the past in a way that should be useful for our future management decisions. However we describe the past in the reporting, that doesn't affect the past. We cannot go back to yesterday and change something. The writing the report in a way differently doesn't really influence the real income from the past anymore. Past is beyond our reach. Future is not. Future is open. That we can influence. Past we cannot. And the very only reason why we do this reporting on the past, because we cannot influence the past, is to influence the future. So seeking information and describing it as objectively as possible and as helpfully for managers as possible, this is the purpose of the task we do. And what guides us there is one of the founding principles of accounting, which is the economic entity principles. That means that recorded activities of a business entity should always be kept separate from recorded activities of its owners or others or partners or other business entities at all. So we define the economic entity. And need for consolidation comes precisely from that. It depends on what is the economic entity that you are trying to run, you are trying to manage. And depend on whatever position or management level you are in the hierarchy there, you should have the adequate financial information about precisely that entity. What are their assets available? What are the liabilities you have to meet? What is the income, has been the income, what can be projected for the future, etc. And that was really my own experience, that when why we need to consolidate is that why I defined it for myself is that I don't like to drive blindfolded. Imagine you drive a car, you don't have eyesight at all, eyes are turned down, you have to drive it only by hearing and by listening to the noises of other cars inside. That it's going to be a very bumpy road. It's better to see that you have around you. And that was my first experience when I came from private sector in the late beginning of the 21st century to the Minister of Finance in Estonia working. And so I basically came from the role of CFO and came into the role of CFO in the public sector, because the Ministry of Finance should be the CFO of the state. And then how do you run it if you don't have the balance sheet? And that's where we started. They only had then these days the cash-based accounting, like any normal probably public entity these days had, which means that we only follow the flow. We don't follow the stock at all. How do you? You don't know the reserves. We only see what cash comes in and cash goes out. And that's precisely when we have the actuarial accounting, then you have the blindfold is off. You have more information. And consolidation means that you need information about that entity that you run. If you run a small bakery house, then you need information about that. If you run a Coca-Cola business empire, then you read information about the full consortium. And if you run the state, then you need to have the best information, adequate information about that state. If you run the local government, the municipality, then also for that state. And have adequate information that is useful in managing it. And again, comprehensiveness, the scope of information should be precisely adequate for any respective level of management. Then the decisions should be made on the level that has the best information, which is the, again, simple hands-on rule. And materiality, benefits derived from information should exceed the cost of providing the information. So if you work hard on produce the information that nobody reads, that is not useful, we should skip it, not use it. And how we started to do it in Estonia is basically backbone is the central chart of accounts, monthly, quarterly reporting by all group accounting entities by 25th day of the month. Quarterly you reconcile, but not in every month, but quarterly, and exact reconciliation only once a year nowadays. And consolidated balance sheets and income statement of all entities published by the end of the next month. Annual report of the state presented for audit by 30th of June next year. Then State Audit Office processes it and presented to Parliament by 31st August next year. But to probably, again, to provide the hands-on, is probably the best to show you just a picture. Sometimes the picture speaks more than 100 words. So I will go to just I go to the opening page of the consolidation system that we have in Estonia. And look at it as a picture because it is meant for domestic usage. But you see the picture here, and the first opening page gives you, this is the list of entities under control of state that we have. So if you go down, it's a long list. But today I see here down, it shows 712. It was smaller, but it also a bit deceptive because it includes both unconsolidated, consolidated, and consolidated entities. For example, I see here, this is one municipality just and the same municipality consolidated. And when to express, I usually, because I work in the Ministry of Finance, then I like to know how my employer, what is the financial position of my employer as an employee. Very simple. So I know that in the here, I can check I know that it's Rahandus Ministry. I know that there is a report there, and that's what comes out, and that is basically the balance sheet. And again, don't look at the text, which is not in familiar language, but you all, I believe you recognize the balance sheet. Nowadays, although this is in Estonian, every web browser has a translate function, which is not very perfect, but I can do it in English, then it's maybe becomes more conceivable. But as you see, you don't, as you see, the web browser translators are not very perfect all days. It's financial ministrum, which is, it should be a ministry. But still, you see the first line is money and bank accounts, financial institutions. You know what the balance sheet looks like and what is available. And this is information available about all these 700 entities. And you do it also consolidated ways because it's the counterpart transaction codes are in there in the chart of accounts. So what I see here is that, okay, my employer still has 1,192 million euros in their bank accounts, so I will probably receive my salary next month. They're all good with that. I can continue working because now we have the treasuries inside the accounts of the Ministry of Finance. And we can do the same just to give a look here back to the and have what we have 9 months.
It was not intentional. For the first line in the fixed assets, yeah. AI translated, not intentional, just to make a disclaimer.
The same is, and I have it translated again, but it is not not too much, but that has been basically Estonian budget fulfillment during the 9 months of the first all the income taxes, social security taxes, bonuses, VATs, etc. The translation, if you get, is not fully correct, notice, but the overall picture it gives you, and one picture tells you more than, I believe, than 100 words. And that is, we have 11th November today, so 31st of October is not available yet, but this is the 30th of September status balance sheet. There are others. I have provided the links here. Basically, Estonian accounting rules or our public sector accounting standard that is based on IPSAS and IFRS, but roughly the links there. But that is, but let's leave more room for questions, I believe. Thank you.
Thank you very much, Guido, for very insightful and easy to present consolidation process you have done in Estonia. By the way, we saw just unintentional like hallucination, Ross says, about the translation, so we should be careful. So we don't have girls on the financial statement as fixed assets. Clearly in Estonia is not the case. So the question to Thomas is, as we talk about consolidation, it's very clear, it's important, it's needed, and then why many countries, many succeed, like Estonia, Spain, others, but why many countries do not consolidate? And why many countries do not consolidate SOEs and municipalities? Specifically, subnational government, they say we do not control or we do not fully control, but despite of that, UK consolidates, many consolidate, others don't. Why?
Yeah. No, thanks, Arman. I think that's a great question, and I think many answers have already been given from different perspectives and different dimensions. I think Ross very kind of rightly mentioned that you need always to look at the constitutional setting of a country. No country is 100% comparable to another, so that you say, okay, as Spain is doing it, why is Austria not doing it, or the other way around? I think it doesn't work in that sense. I think what you first have to identify, and I think we talk about that later during the day, is what is the criteria, what is the process in defining the parameter. Control, according to IPSAS, is one solution, but there are others which are discussed following GFS parameter and others. So I think that makes it a little bit more complex. On the other side, I think what many countries are shying away from is the complexity and the workload kind of connected to that. And I think somebody said it, and I think it was Ross saying that consolidation in most accounting reforms is the last phase of the reform. Many countries are still struggling in getting the kind of single financial reporting right, and do not yet think about the next steps, but they should. And I think it has been apparent and coming out why they should do already at that time to do that. And we will talk about again later on how to kind of set the preconditions in terms of chart of accounts, in terms of defining harmonized accounting policies and things like that as a precondition. It's never too early to start with that, even if you're at the moment just kind of in the phase of single financial reporting reforms. Many countries did not invest in technology. If you kind of, and I'm kind of dare to say that my home country does not even invest in an ERP system for the Ministry of Finance itself, not talking about any kind of supporting technology for consolidation. And of course, and I think we talked about complexity, if you don't have supporting technology, if you do it on the basis of an Excel sheet, I think it's a hell of a complexity and complex undertaking. So that is also something that the preconditions from a technical side are not yet existing, which is hindering many governments. And I think Estonia has just been a brilliant example. I'm so jealous, I have to say. Just drill down and, okay, this entity and drill down and you have the first 9 months. That's something we can only dream of. And so that is what creates the conditions for consolidation. So many different arguments, but still no conceptual argument not or to lose it out of sight as an ultimate objective. And I think many good arguments have been provided in the presentations why we should kind of aspire to have it at the end. Different reasons for different countries why they are not yet there, but we shouldn't lose out of sight where we need to go to.
Thank you very much, Thomas. So your perspective is just you need to the constitutional setup, the legal basis, whether it allows and how consolidation, this is one approach. And the second element to consider technology, whether technology is there to support, whether there's a unified chart of accounts, as in many countries is used by all the entities, which helps just to tag the transactions and then try to eliminate. And also probably just the perspective of which is the coverage, GFS 2014, general government sector, which covers for statistical purposes by default subnational government, but for statistical purposes, while IPSAS we have controlled concept. And then Ross, what if we go with equity method, the consolidation? How, of course, IPSAS 35 and it requires or expects and it's line by line consolidation. What is the impact? Is it a shortcut? Is it a solution?
Yeah, thank you. So I think it is very much a shortcut, and you can use equity consolidation as kind of an interim step as you work towards full consolidation. It does give you information. It is useful. I think Bernard's presentation, though, really highlighted the risk in that. Again, he said he did a simple exercise of a couple of days worth of work based off of financial statements, starting with the biggest items to consolidate. And you could see the scale of the difference in the balance sheet and the statement of operations from that small exercise, the significant difference in liabilities, assets, revenue. The point on the depreciation charge that you noted, if you're really trying to capture the cost of services and factor that cost in to manage it appropriately, I don't know how you could do it without consolidation in that example. You're really kind of, the last slide I showed was kind of blurred vision versus seeing clearly. And I think Guido talked about driving with the blindfold on. I really think if you're relying on equity consolidation to get your financial picture, you don't have a clear financial picture. In particular, as you look forward and think about contingencies, liabilities, and the total number of assets under control. I really do think it is a shortcut. I don't think it's a good shortcut in the long run. I can see it practically as a step towards proper consolidation. And I think, the Estonian example is a perfect one to show that with, the investment in the right things, I think the IT systems in particular, you can realize consolidation and follow control and the single financial picture. And I know there'll be more presentations over the next couple of days that will talk about that, but I do think it starts with IT solutions, multi-dimensional chart of accounts. And one plug I'll put in that is it's not just for consolidation. If you have these systems and the multi-dimensional chart of accounts, you can then use that accounting information for utilization in more decision-making processes by integrating it with your statistics preparation and even your budgetary preparation. That entity level financial accounting information is pure gold for decision-making if you design it properly in your systems to utilize it.
Thank you very, very much, Ross. Then probably as we talk about Austria, and yes, Bernard made very clear case of why to be consolidating and why Austria does not consolidate, when Austria will consolidate, or are there plans, and when are you going to find those 50 billion euros liabilities and much significant assets?
Thank you. Yeah, I would say to a part a painful question because I have been involved in Austria in the Ministry of Finance when we developed the reform. And I would say why we didn't go for consolidation was maybe threefold, right? So the first one was we didn't actually see it as a problem at that time, to be honest. And maybe that was naive, right? So we saw, well, our SOEs are well established, they are well run, they use IFRS. So, it's a financially solid country. So what should go wrong, right? So I might second guess that's judgment at the time, knowing what I know now. And taking Guido's example, probably it's really good to say, yeah, you can drive blindfolded, but it's not a question if you hit something, it's a question where do you hit something, right? So I think that's a good point. The other one really was that, like I said, I mean, this has been an exercise of a couple of days, but I have to admit, 12 years ago, I wouldn't have been able to do that. And I think it also goes back to Adrian's point value early on. You need the technical skills, you need the cadre, you need the practice to really get over the point of caution where you are really kind of having very respectful about the exercise and as much respectful that you don't even start. So there is a technical element associated to that. I think it's really important to stress. And the other one always is this kind of question on the political willpower, right? So I think we have to recognize that in the public sector, IPSAS is not mandatory. So I think you always have to have a clear issue, a clear problem you want to address with your accounting system or with your PFM system. And if you cannot make the case for that, then probably you're not going to get the approval for the solutions. So it maybe is a bit of a fact-finding exercise on what is actually the issue with driving blindfolded.
Thank you very much, Bernard. So just your reflection is that, yes, it was probably a bit of naive to think that consolidation would avoid consolidation is not needed, but now your exercise demonstrates how much value in terms of information. But you also connect to the political will, so the business case for the leadership, why we should invest in consolidation, and also the capacity, which you didn't have 12 years ago, and now with capacity growing, you're approaching to consolidation. Then, Ian, the question is to you. You just, like UK, we talk about the best one of the most, advanced countries, and we still National Audit Office disclaimer, you referred of opinion. So then what is the value of consolidation then, if even the Supreme Audit Institution provide disclaimer on the government financial statements?
So I suppose I've got three thoughts. So a disclaimer opinion obviously is not something that that anyone's particularly proud of. But it's really important to understand the reasons for the disclaimer. So it's not the whole. It's not the whole exercise. It's specifically related to returns from local authorities. So we have a phrase: "Don't throw the baby out with the bathwater." And there's a risk that you can do that. So actually, there's a lot of assurance being provided on a huge amount of public spending in the UK through that opinion. There is a sizable gap there, which obviously the National Audit Office have had to reflect on. So I suppose that's the first point. The second point is that the disclaimer, and going back to the point I made about transparency and accountability, well, actually the disclaimer opinion then has resulted in a lot of parliamentary scrutiny around the process through our Public Accounts Committee, and also coverage in the press. So, and not just the kind of accounting press, but also our mainstream media outlets as well. So I think it's really, it's really shone a light on the issue. And then I suppose the third point I would make, which none of us have really touched on this morning, is I think as you're thinking about financial reporting and consolidation and the processes, you need to be thinking about the assurance of those at the same time. So it's really important that Supreme Audit institutions, audit providers are absolutely alongside you as you go through that process. And that's certainly something that we've learned, to our cost, I suppose, at the moment in the UK. So I think you could say, well, what's the point? But I think there's it's looking at the assurance that you're getting, as well as the light that it shines on some of those latent issues as well.
Thank you very much for providing insight, Ian, and also just the reasons for disclaimer. And I think many in the room knows that there was also a disclaimer regarding the equity method consolidation of the banks, like Royal Bank of Scotland. As there was UK tried to consolidate the whole of government financial statements, and because of the size of assets and liabilities, the government financial position performance was lost. So they decided to go with the equity method, which was another reason. So this means that you need just to do, if it is financial sector, banking specifically sector, you should be on country by country, case basis, just explore how to consolidate. Thank you very much for the insights. Of course, we will open for a few questions from the audience as well, just to be prepared for the audience for our participants for question. And Guido, everybody's like envy on you, specifically not personally on you, and not your presentation, but it's about how you make these things so simple happen. Is it simple enough? How costly it is just to have that platform you click and you have 9 months consolidated, 3 months, year for all the entities. It's open for, I understand it is open for public, right?
Yes.
Yes, it's open domain. And how costly is that? What are the prerequisites of making this simple as we look at simple consolidation?
That what I showed is not an accounting software, it's a consolidation basically and presentation place or marketplace, I would say. where it happens, but it is not, we have had it for 20 years. And before that, we made it in Excel. So it's not costly, no. But it's not an IT issue. It's backbone is the chart of accounts.
Yeah.
How you map your economic entity of how you want, that is accounting work actually, how you do map your costs and revenues and entities that you have and their interim transactions they have inside. So this is not so much it, but I wouldn't be afraid of that at all. This system came out some years later. So before that, we just published it, reports on the website. But what you said was a treasure stove of information. But what I would practical experience from hindsight now is that what we did accounting reform, we reformed accounting. Yes, we got the information. But we didn't, at that time, we left the budget out of it. And that is where the real power play is. And that makes me always, that is an issue why there is much of it is unused. And as a provider of that information, that of course I do regret it. It should have been much more used. But the reality is indeed that the political power, political struggle goes on the political level. The key word here, I believe, is the financial literacy. How to teach them to read and use that information that they have available for decision making in every level of management, starting from the local municipality to the prime minister and parliament. We have some politicians that have acquired usage. They know where to go because there is really very transaction-based data available also. Who has paid money to whom, for example, and inside the consolidation group and what transfers have been made. And you can find it, track down and ask explanation for that. And State Audit Office, of course, uses the parliamentary process that to present it to Parliament, to criticize whatever they found. And this is that they have notifications in there. This is quite normal, but that is why they are there. They need to present the basis to improve. And that is their very function. But overall, yes, financial literacy in the political level is the keyword, how to teach these that in management really to use the information. That is still, I have always wondered why are they struggling about the budget in the political level, because the budget is the plan and the statement is the actual performance. I have often received some bonuses for good performance, but I have never seen bonuses in my life for drawing up a good plan. That hasn't happened, but they are struggling about plan, budget deficit. But so is life. Yeah.
Thank you, Guido. So you says that interesting remark. So it means that IT is critical, helping to simplify our life for consolidation. But for country of Estonia, also scale potentially matters. You can do it also by Excel. Second, your remark was that the key here we should watch is we should focus on is chart of accounts, so which provides the basis for consolidation with proper tagging. This is the key element. And third is not only the financial knowledge, the IPSAS or accrual knowledge of preparers, but financial literacy of users of the financial statement, including politicians. So we keep them in the radar screen. As Ina says, we should look into the assurance providers, supreme audit institutions, potential internal auditors to be involved as key stakeholders. We also need to look into the focus on the
materiality principle, KISS rule, keep it simple, and teach to translate and teach the users for that. That is the key issues. Nowadays, we often, when we make decisions, we perceive this kind of lack of information, but in reality, we live in the information overflow. So it's hard to interpret the information we have. So if in the end of the day, 80% of the financial information when the reader gets from income statement and balance sheet. And then, but that is 2 pages. But our reports are, annual report is 200 plus pages. So if we Pareto rule applies here. 20% of effort gives you 80% of result, and you are already roughly right. And so it can be kept simple.
Yeah, just thank you very much, Guido. Any one, we can probably one question from the audience, if yes, please. And okay, two questions, first and then second. You can go give your questions and then we will reflect.
Okay, Marina. Okay. Marina Trpeska from North Macedonia. Just to make disclaimer at the beginning, I'm from academia, not enterprise, state enterprise. I want to share one or to give answer on one particular example for North Macedonia. Local government enterprises and also state-owned enterprises are not in good conditions as usual. And usually they have a need to borrow money from private sector, and then the country is guarantee for the loan. At the end, the enterprise is not paying the loan, and the country, the Ministry of Finance, will going to pay the loan for them. What is the accounting evidence? The company is making evidence for liability, and the Ministry of Finance making evidence for receivables. We are on cash-based accounting, and at the end we have receivables in the financial statement that are not going to pay never, because the state-owned enterprises never will have enough money to repay the Ministry of Finance for the past loans. What will be the right
Thank you very
solution
much.
in this?
Excellent question. And we see in many cases that the government, I mean, actually last week I was on a mission 2 weeks ago, the government provided one of your countries $180 million to a state-owned enterprise, which is non-recoverable. And in the solvency, the question is still in the financial statements of the government. So how to deal? This is one question, and there was second. Let's grab and then we'll react, right? I will ask just one to react. Yes.
Good morning. I have a following question. And the government's consolidated financial reporting, which kind of organizations are included? So budget entities are included, it's clear, we all know about that. So what are other entities that are included? Also, we have public law entities. They have commercial activity as well. They have some commercial operations. So what kind of entities are included into whole of government consolidated reporting? Thank you for your question. And the third question, and then we move to answers to have time to finish. Thank you. I'd like to ask my question in Russian as well. Based on constitutional order of the state, of the government, where we'll have a different status of the entities, of the institutional units. For example, in some cases, we can say vertical entities, the controlling entity and the controlled entity. And in other cases, we have constitutional structures which are independent. They are horizontal. These units are horizontal, and so there is no control. There is no controlling entity. We cannot say that this is the controlling entity. My opinion is most likely we need to call this financial reporting the aggregates financial reporting, and we need to use the instruments of consolidation. This is similar to commercial sector when there is the individual, the natural person, and so there are different entities consolidated or controlled by this natural person, by this individual, but individual cannot do consolidated financial reporting. But we need to merge all these entities in some way. When we do this aggregation of those entities, most likely the mechanisms are used, which are used also for consolidated reporting. What do you think? IPSAS doesn't cover this. Local government is not subordinate to the national government. At the top, we have the government, but what is the government?
Let's then now reflect on the questions. So first question, Ross, the question about, yes, please. The mic, please.
So I think if I understand the question correctly, you're asking how to treat these subsidies from the central government to state-owned enterprises when loans and they're not recoverable. Well, again, the answer is pretty clear in IPSAS. If you're applying IPSAS, we have financial instrument standards that relates to receivables and payables. And so, for example, if you provide a subsidy from the central government to a state-owned enterprise that from day one is unrecoverable, you'd impair that, you'd write it off. I think Thomas wants to say something as well.
Just as an addition, I think what I understood is that government is paying the loan to the private sector instead of the state-owned entity, which is not able to pay it. And then government puts a receivable against the SOE in its balance sheet against the liability of the SOE. I think under consolidation, what happens actually is that you eliminate both and nothing appears anymore. So you don't have to ask the question, what value has the receivable? Because it's not existing anymore in the consolidated financial statements of the government after consolidation, given that SOEs are controlled in your example. I think in the end, it's a liability of government as a whole to the private sector, which funded the activities of government, regardless whether it's SOE direct or whether it's SOE or whether it's government indirectly. So don't worry about the kind of measurement of the receivable, because after consolidation, it doesn't exist anymore.
Thank you. And the second question is about how do we deal with those entities which have some commercial activities, not purely budgeted entities, and not SOEs, somewhere in between.
Yeah, I think that's an important point because probably that's most of them. So I really haven't seen, let's say, SOEs which basically would be private sector entities and do not have any public sector mandate in any way. So you might have this time in financial crisis when you actually the state picks up, let's say, a company, tries to bring them to life for a couple of years, and then gets it on the market again. So I think it's important to consolidate them as well, because what it actually shows you is that you are an active market participant. That means that you are impacted by the market, be it by the cost to produce services or products, or by competition, right? So if you are not consolidating those entities, you are not getting the strategic fiscal policy input on how to behave as a government. Should you leave that market? Should you invest in that market? So you are a participant. So I really would recommend taking that perspective on.
Super. Thank you very much, Bernard. Super. And yes, from the control perspective, IPSAS perspective, it doesn't matter whether they are engaged in commercial activities or not. You have to consolidate. And you are raised a very good question. We have many SOE having legal forms like SOE or non-commercial entities, but they are engaged in commercial activities, or they are having SOE legal form, but they are not engaged in commercial activities. This is a different topic of how to deal it. The process is, if you control from IPSAS perspective, you consolidate. If it is part of general government sector, for statistical purpose, you consolidate, including subnational government. And the last question, which was raised, is about what to do with the entities which are not controlled by the government, like Constitutional Court, Parliament, other agencies, competition committees, and so on, which are outside of the perimeter. Do you consolidate, and how do you consolidate? Shall we apply, for example, IPSAS 22 is more relevant in that case as disclosure of the whole general government sector, or how to approach? Thomas, would you like to just reflect on that?
Yeah, it's a very quick answer to what I understood was the question. Actually, if you don't control according to IPSAS, you don't consolidate. I think IPSAS 22 kind of providing information on kind of additional information about the general government sector would be very helpful in that sense. That would not lead to something what we call aggregation, but it would be additional information kind of on the general government sector as a whole.
So the answer is just use IPSAS 22 from that perspective. You do not control, and this is also the same basis to bringing in municipalities, for example, or subnational government that you do not control, but you would like to consolidate to have the whole of government picture. And because we are, yes, Bernard, we're trying just to, yes.
Maybe just one sentence, because we have the same situation in Austria, and it's currently really painful. So that you're not controlling the municipalities or other entities does not necessarily mean you do not have a relationship with them. And the question now becomes, what is that kind of relationship? Is it a financing relationship, or is it a contractual relationship? Do we expect any performance by those entities? So that's, I think, an important question, and then you will find some IPSAS to apply, I'm sure.
Exactly, and then there will be, we can continue because this is just first session, friends. And the question here is also coming to the point if that you do not control, what do you mean? Constitutional, you don't control, but in reality, I'm not aware of any country here in this room that has subnational government municipality went bankrupt. We have one case in Poland, recently one single case among thousands. But it means the government provides subsidies, financing. So constitutional setup legal is one point, but in your countries, majority of your, we know very well, right? It's completely you find the central government financing them and provide subsidies, grants on a regular basis, and they at the end responsible, and they are covering their liabilities. Just because we need to close for the coffee break, only exception for Ukraine, and we will close.
Thank you very much. If I may, I will speak Russian. Thank you very much to the speakers. No doubt it is very valuable information, very interesting and useful. I have a quick question. From practical perspective, to disclose information on consolidated reporting, it's very important to disclose information on segments. Tell me, please, from the practical perspective, if, for example, in Estonia, the disclosure of information on segments is it done, and what are the principles of allocating segments? Maybe you can answer this during this session or next session. It is a very important point because it is very effective to inform the government about financial performance by segments of economy which are consolidated in the country. Thank you.
Yeah, we can good. You just react, and then because this goes into practical aspects, the Peter session, next one. So just quickly react, and then Peter session.
Yes, it is by the segment. There is one classificator in the chart of accounts for that purpose, but basically that is made for statistical this ESA accounts available. For the others, I would so much comment at how we have solved it. For the Albanian, I believe it was example, if the government has a receivable from the SOE that is never gonna be paid back, that shouldn't be there in the balance sheet because the recoverable amount is zero, that balance sheet wouldn't be true and fair. That as simple as that, it should be recognized as an income in the enterprise and cost on the government and neutralized in the consolidation process. But the liability to external bank definitely remains as on the government levels. And the same applies to these, I know the problem, not business entities that kind of are public entities. We solved it that way that in Estonia, for example, parliament is independent. They are not controlled by government, president, Supreme Court, etc. And also University of Tartu, for example, independent legal entity. All independent legal entity, we draw the principle there, the line is there by the legal entity. Municipality is another example such. They are, by the law, they are put into the consolidation group because they belong to the citizens. In the end of the day, they belong to the citizens. And if it is also a question of management, also familiar for me, how do you exercise control? And if you're not able to exercise control, then that I've seen in private sector quite a lot. If owners are strong, then the director is owner. That is the question of management, public management, not the accounting so much.
There was a broader, yes, excellent. Thank you very much. There is a broader question. So we'll continue with the practical next session. And also on day number 3, we have Word Cafe, or we call it, could be a fishbowl, where those questions we just have a chance to. Let's just applaud to the speakers on the panel. Thank you very much. Friends, let's move to our next session. It's consolidation of SOEs, practical aspects and trade-off, as we start debating during our previous session, how to. And I am very pleased to pass the floor to my esteemed colleague, Peter Ladegaard, senior governance specialist. And Peter leads our SOE community of practice, where we're approaching the same topic from different angle. On our side, the WorldBank side, we're also connected with Peter just to consolidate and coordinate. Peter, the floor is yours. Thanks.
All right. Welcome back, everyone. I know coffee breaks do take time, but I think we have quorum to begin now to this very exciting session on consolidation of SOEs, practical aspects and trade-offs. As was just said by my good colleague here, I'm working on corporate governance across the region, corporate governance of SOEs, and similar to what you have with these very exciting communities of practices, we also have a community of practice dealing with corporate governance of SOEs. And we're extremely happy to have representatives of that community of practice in this group here today, because we truly believe, as we've heard from the previous session, that there's huge opportunities for these communities of practice to enrich each other, especially when it comes to such exciting topics as we have today. I think we established pretty well the answer to last session's question, namely, whether consolidation matters. I think we heard a overwhelming yes, it does indeed matter quite a lot, especially on SOEs. And I do really like also some of the insights that we heard from, I believe Bernard shared from Austria, where you could see the magnitude of difference that this could do just from spending a couple of hours of looking into this in the case of Austria. But before going into the details, let me also share a couple of data points about the magnitude of the SOE sector, which will give an indication of what the importance is here. SOEs are actually among the world's largest firms, and over the last 25 years, the share of the largest 500 firms in the world has grown from 34 to 126 SOEs. So 126 of the world's largest 500 firms are actually SOEs. Also, when it comes to capital markets, SOEs are a gigantic factor. As of 2023, so a couple of years ago, the ownership of SOEs accounted for more or less 12% of global market capitalization. So also a huge factor. And similar when it comes to exposure, risk, and debt, I think we all know that this is also a significant challenge. So some of these global trends are reflected in what you're seeing on either on or slightly off your balance sheet. We get a sense of the magnitude of the challenge here today. So having established this, why this matters, we're now going into the what and the how. And I'm extremely happy to have with us these three distinguished speakers with us today. I think going into this session, we should also be aware of the fact that was said multiple times in the beginning. When it comes to consolidation, especially consolidation of SOEs, we do not at this point have firm answers. This is an exploratory exercise where there will be lots of learning taking place, and there will also be experimentation and possibly a couple of errors on the way. But I think, as you will hear from all three speakers here, it is about getting started. Our first speaker is Immanuel Frank Steinhilper. He is the senior government specialist, and he's the lead of the World Bank's Global SOE Governance Program. He will begin an overview of the general considerations for SOE consolidation and also discuss the scope of entities to include and the balance of between SOE accountability and independence. Our next two speakers, I have come to understand that you are such famous people in this audience, and actually not even go into a longer explanation of who you are. But in any case, after Emmanuel, Thomas will follow, and after that, Bernard will follow. And then you are encouraged to ask questions and answers, come with questions for the podium to answer. We do have some questions already lined up, but I would encourage you already to start thinking about those. So without further ado, Emmanuel, you are first up.
Thank you very much, Peter, and good morning to all of you. I'm coming at this more from the corporate governance SOE perspective, so I may see a few things maybe a little bit differently, but having been asked to speak about the practical aspects, here are some of my top things that I put together. And I came up basically with three key dimensions. The first one related to the scope. There's really a decision that needs to be made on what should be included in the consolidation. What kind of entities are we talking about? And then, of course, the precise consolidation method. The second one, and that's really the one from my perspective I would like to stress most, is this question of balance and the trade-off between the SOE accountability and the SOE independence. And I will elaborate a little bit on that. And then last but not least, all these practical implementation considerations, how to convert the SOE data into something that's more similar, IPSAS compliant, that you can actually do the consolidation, the whole question of processes, systems related to that, and then of course the practical application, the learning, the adjustments, and evaluation. So jumping into this question of the scope, I think from the IPSAS perspective, from the accounting perspective, we have pretty clear guidance on what to include. But the devil is sometimes in the details. But to run you through a little bit, maybe a few more general considerations. In principle, I would say the closer the entity resembles a public sector entity, a budget department, a ministry, something of that notion, the clearer I think the inclusion in the consolidation exercise is. For instance, if we're talking about more public agency type of entities or SOEs that have more of a social rather than a commercial function, I think for the most part, it's pretty clear that they should be consolidated. Then, of course, also on the commercial SOEs, from the accounting, from the IPSAS perspective, at the end of the day, if they're controlled, if they're material, I think the guidance is also clear, they should be generally included. But there I would make a little bit this footnote that is really important not to go overboard and undermine the independence, the operational autonomy, which is really an important notion in corporate governance, and not unduly stifle them. Then maybe there's also a consideration on the scope. Big entities probably should be a priority. I guess that's more of a practical consideration. And small ones, in principle, yes, as well. But maybe from a practical perspective, you may go a little bit step by step and roll them in over time. And then you have all these borderline cases, what to do with minority stakes, with PPPs, special purpose vehicles. There you may have to make a judgment on how to include them. Now, the second big point I wanted to stress in this whole exercise of consolidation, you will come to confront certain tensions and trade-offs. And the first one is probably the most strategic one. You have to trade off a little bit compliance versus competitiveness. And the way I put it here, don't gain compliance, but lose competitiveness. So from an SOE corporate governance perspective, the one thing I would like you to remember is that the OECD SOE corporate governance guidelines, which is the gold standard in this area, really recommend the operational autonomy of the SOEs. There was a reason why they were made independent from the state in the first place. And the idea is they should be, for the most part, treated like public sector entities in terms of their accounting. It's typically recommended that at least the commercial SOEs adopt the IFRS. And the legal form and all of that, they should emulate more or less the private sector practices. Whereas from the IPSAS and accounting perspective, of course, the interest is more on the control side, the SOE accountability. But at the end of the day, somehow you need to balance these two considerations and ensure that the consolidation exercise does not completely defeat the purpose of the operational autonomy. And then the second trade-off is probably a bit more of a practical one, but that some of you may also be able to relate to. I think we have to remember that in some countries, we're talking about thousands, literally thousands, in some countries, even tens of thousands of entities. So it's not something that can be done very easily. And you may need to have a little bit maybe of a prioritized, sequenced approach. Also, I think it's good to remember, although some countries have been able to do it, in the broader picture, there's still many countries, including countries with very sophisticated accounting systems, that are not there yet. So I think it's also the encouragement. We shouldn't maybe be too hard on ourselves, but we need to get started somewhere. And I think that's also the message. Others have not done it today. It should not be an excuse for us to be completely idle, but see it a bit as a process and a step where we can move towards that ultimate objective of consolidation. And along the way could be a step-by-step approach, maybe including some entities first, maybe testing a little bit. And I'm saying this from a SOE corporate governance perspective, maybe even this, however imperfect it may be, practice of aggregate SOE portfolio reports can be a useful intermediate step on that journey. And then last but not least, to conclude on a few practical considerations that I gathered here, I won't go through all of the list, but again, really the need to define the universe that you start with, then to harmonize the data that you have, the question of the comparability of the SOE data with the general government data, the notion of IFRS, IPSAS, how to convert, translate this information. Again, the question of maybe start with the largest entities and then expand over time. The notion of systems, processes, how can you standardize, how can you facilitate, how can you automate this process is really critical. Both to make it easier on the entities, on the government, but at the end of the day, it's of course also a cost and time factor how to be able to actually do it. Then I think there's a notion also of sharing the burden. I think consolidation at the end of the day, it's more something, it's a public sector responsibility. So even though you may require the SOEs to provide data to help in that exercise, the government, Ministry of Finance, whoever may be responsible for the consolidation, should really do the heavy lifting on this. Also, again, before the backdrop of not overly burdening the SOEs and reducing their competitiveness. And then last but not least, I mean, can also be a practical way, maybe doing something like Bernhard showed to us earlier. Maybe just try to do it. Maybe do a pilot, do an exercise and see a little bit what the consolidation tells us without being too perfectionist for the first time, and maybe also without requiring like the formal assurance or the complete accuracy in the first exercise. So I'll leave it with that and hand it back over to you, Peter. I'm also excited about what my fellow speakers will tell us. Thank you very much.
Thank you. Thank you very much, Emmanuel. This was excellent. I could read from the body language of my two other partners here in the panel that you did say a few controversial things, so I'm sure we'll have a good debate subsequently. But I'll now leave the floor to you, Thomas.
Yeah, thank you very much, Peter. And actually, you're right. I think that's the beauty of having mixed panels. There's a lot of common ground, a lot of things I agree to. Some I look at that a little bit different, but I think we will find kind of common ground in the discussion anyway. So just to kind of look quickly at the outline again, I just want to provide a little bit context and relevance. And I think the first session, and especially Bernard, did an excellent job in already paving the way why dealing with SOEs is so relevant, and what the practical outline or practical problems might be. And I think Emmanuel already attached or kind of went to a couple of that. I just want to quickly look at the data flow. So what is, in a very simplified way, the flow of data from an SOE into kind of fully consolidated financial statements, before we dive then a little bit deeper into the practical challenges from multiple aspects. And again, I think a lot has already been covered, not only in the presentations, but already via your questions and the answers provided. And last but not least, I want to conclude with some actionable insights building on what I have kind of alluded to. So starting with the context and relevance, and I think it could not have been said better by as compared to what Bernard said. I think governments, of course, their main task is to provide services, but in many cases they don't do that directly. They use state-owned entities, they use independent entities, legally independent entities, but they direct them. How to do that, at what price to do that, and what kind of services to provide. And we see that very often in the energy sector, we see that in the health sector, transportation, just as some of the examples. And I think as Bernard really very well outlined, and I'm amazed that this is the result of just a few days work, so nobody should kind of have an excuse anymore not providing a comprehensive picture. Material assets, but also liabilities and risks are connected with these SOEs. And I think on a first view, everybody of us would have said, yeah, of course, liabilities and risks is the main point. But I think as you have shown kind of really greatly, it's the extent of assets as well, which is involved in providing the services. So it's without any kind of doubt that consolidation of SOEs is relevant and is necessary. Of course, they are providing single financial statements. So both government, ministry is providing financial statements, and state-owned entities are providing financial statements because they are both reporting entities in itself. That's not yet the problem. The problem is that, let's take an example, the government is using IPSAS and the state-owned entity and preparing its financial statements on IPSAS, but the state-owned entity is using another accounting framework, might be national accounting framework, might be kind of required by the sector. Energy, health very often has very specific accounting and reporting requirements, which are not kind of like comparable to IPSAS or what IPSAS requirements might be. So we have different financial statements. And actually, I think this is where we think about where are the problems. And the problems are kind of coming from that we said we need to have one single financial statement for the group reporting entity. But now we have different reporting frameworks. We have IPSAS on one side, we have the other accounting framework on the other side, but we want to have consolidated financial statements on the basis of IPSAS. So what is required now is kind of getting the financial information from the SOEs on a comparable basis, in green, which means on an IPSAS basis. Very often you hear we don't have the power to direct the state-owned entities to provide us the information in the way, in the structure as we need it. Okay, if that is the case, then I think we need to open up the question of control, because if you don't have the power to direct a subsidiary to provide the information and the data in the way as it is required, probably you might not control them, and they are outside of the consolidation perimeter. So think about that. So that's the context and the relevance. By the way, it's great. We have this timing on our screen here. And for me, it's all the time saying thank you. It's fantastic. All the time. Thank you. So look at the data flow. And that's, of course, admittedly, a very simplistic data flow model from an SOE trial balance to group financial statements. But I think it's important to understand that when we talk about practical challenges. So, of course, we are starting at the left side with the SOE trial balance. And just imagine, again, it is like on the basis of another accounting framework, not the unified accounting government policies. And so the first thing you need to do is standardization and mapping to IPSAS or to the national accounting framework, which is used for the consolidated financial statements. That's the first step. The third step then is the data validation and intercompany reconciliation. That is just talking about, and Guido said that it's done on a monthly basis, just to agree on balances. And you will be surprised, or probably you will not be surprised, what level of differences you find for the same transaction on two sides of the transaction and of the picture. And only then, if you have done that, you can do consolidation adjustments, and you can do what I have said in my first presentation, what is called the eliminations, in order to kind of exclude all intra-group and intercompany transactions. And we talked about the receivables from paying loans of SOEs in the session before. Then we talk about aggregation of data, but please, not aggregation of data in the sense as we discussed it earlier, just putting financial statements under each other. Here we are talking about putting data together in kind of the sense of presentation to have subtotals and totals which are meaningful, and only then you can prepare the group financial statements and disclosures. So that's very simplistic, the data flow, in order to understand what are now the problems along these paths. And actually, I clustered it a little bit similar as it was clustered before. The first thing is actually, of course, defining the consolidation parameter. And I kind of touched on that already to some extent. And I listed here some borderline cases, which in practical discussions always create discussions. PPPs were mentioned already. So corporations under joint control. Of course, public financial institutions like development banks, banks in general, social security funds are a problem. And commercial SOEs in competitive markets are to some extent a problem. I would rather look at that not as being a problem for the independence of the SOE, but rather if it's too big, that it blurs the transparency and the picture of government's own operations. This is not that I'm saying you shouldn't consolidate them. It's about presentation and presenting the information in a way that you can understand what is government's own operations, what is government's actions, and what is happening at the SOE part of kind of the group reporting entity. I think definitely segment reporting could be very helpful in this regard, providing clarity. And then in this area, we talk about classification, mapping of entities, and I'm alluding to that in a little bit more detail in a second. So the core issue here is to decide on entities to be included and define how they are integrated. Again, as I said, we'll look at that on the next slide a little bit more. Then we talk about data systems and timing issues. And this is where kind of I tried to illustrate that in a previous slide, that we very often talk about heterogeneous accounting frameworks. Might it be IFRS, might it be local GAAP, might it even be cash-based in some cases, or something what you call modified accrual, which is something in between. We talked already about different reporting timelines and year ends. And very often we have the same year end, but we have different reporting timelines. So data from SOEs is simply coming too late or not in kind of a coordinated process. Inconsistent information, of course, the topic of a harmonized chart of accounts is very important in this case, to have a harmonized data structure. Recognition coverage, so what assets are being recognized on balance sheets can be hugely heterogeneous and a topic which creates practical challenges, as well as valuation methods or disclosure requirements in depth. And last but not least, of course, identification and elimination of intercompany transactions is definitely a problem. And what causes the biggest question is always, what is the character of the remaining difference? So if there is kind of like an asset as a remaining difference of eliminations, what does that mean? Is that an asset? Has that any value? If there is a liability remaining, to whom is this liability? What is the character of this liability? And I think, again, Estonia has kind of developed a very good practice in that. Again, I'm very, very jealous for that solution. So the core issue here is get reliable and consistent data, align with government accounting policies. And the last point is governance and audit. We just talked about that during the coffee break. So far, we have not yet touched on the aspect of audit, because of course, there needs to be a coordination between the finance ministry as being the preparer of consolidation and the SAI as being the auditor. And there has to be a coordination between the Supreme Audit Institution and the auditors of the SOEs, in many cases, private sector auditors. So they need to know what is the focus area, what is kind of like materiality understanding, where is kind of the risk structure from the perspective of the group auditor. So talked about lack of common materiality thresholds. And in that regard, ISO 600 is providing a very good kind of, let's say, guideline how the group auditor should communicate and coordinate with the SOE auditors. So the core issue here is ensure credibility of consolidated information. And that leads me to the next slide, actually, and I talked about classification and mapping of entities, and we heard that sentence already. Just to explain what is the difference. So classification of entities actually is kind of the purpose to determine which entities are controlled in the sense of IPSAS 35, if you use that as a criteria to define the parameter and which are not controlled. And again, I think practical issues in getting data from an entity might be a hint whether it's controlled or not. So classify that as a budgetary, extra budgetary, SOE or social security fund, and define and document the basis for what is included and what is not included and why is very important, especially for the audit process afterwards, because you need to communicate to the auditors how you came to the parameter decision you made. In the opposite, mapping of entities. This is talking about linking each entity's accounts into the consolidation system. So in other words, how do you integrate these entities in the consolidated financial statements or in the consolidation process? And I think in that regard, Guido's perspective or Guido's example showing his life example was very, very well supporting this because you saw that every entity had a code, and the code was like an organizational tree. So there were sub-consolidations with 3 digits, and kind of the other entities being included in that had 5 or 6 digits. And this is very important in order to structure the landscape and in order to kind of from an organizational perspective, enable consolidation. We talked about the chart of accounts and the consistent data collection. So in a summary, classification is who is in the group. Mapping is how they are integrated in the system. And now very practical, how is it done? In practice, how is data kind of provided from an SOE to the consolidating entity? And what you find in practice is the so-called reporting package. The reporting package has 3 columns. The first column is the data, the financial information on the basis of the primary accounting framework of the individual entity. Might be national accounting, might be specific energy-based accounting requirements, whatever. The second column is the adjustments to align with the unified group accounting policies, which provides that you have defined unified group accounting policies beforehand, but this column is kind of making the adjustments in order then to arrive in column 3, which is the unified accounting policy financial statements of the SOE, which then only can be integrated and consolidated. So, of course, it is essential that you have a harmonized data structure, and this is where we come to the aspect of having a harmonized chart of accounts. And at that point, I just want to highlight that there is some practical guidance from the IPSASB when it comes to consolidation of SOEs. It's an IPSASB staff document, and you can kind of download that via the QR code on the slide. What it is saying in essence, and the key message is, if the primary accounting framework of an SOE is IFRS, and the unified accounting policies of the group is IPSAS, then the adjustment should be not that much a problem. And that is, of course, and you know that basis for IPSAS is, as a starting point, IFRS, if there is comparable transactions in the private sector. So, and that brings me to my conclusions. Just 4 actionable insights. First, start with mapping and classification of entities. Get an overview on the landscape of what do you have, what is in, what is out, what is your basis of differentiation and decision to define the parameter. Second, develop a legal and data governance framework for consolidation. So what is kind of the organizational frame, who kind of requires data from whom, and who has to provide data to whom? And I think that is something Emmanuel already touched on from his governance hand and from his governance perspective. Third, very important, invest in capacity building and training, both on the SOE side, but also on the side of the consolidation center. And last but not least, and I think that was mentioned as well, use pilot consolidations before a full rollout, because with kind of pilots, you identify what will be the practical problems in general. So thank you very much, and looking forward to your questions.
Thank you very much, Thomas, and also for making this even more tangible and specific with reporting packages and the emphasis on piloting. I think we're now going to hear a little more about the specifics and the practicalities of Bernhard. We're very much looking forward to the continuation of your first presentation this morning, so expectations are pretty high.
Yep. Happy to hear. So just waiting for the slides to come up. But I'm really happy to again be in a position to be able to draw from Emmanuel's and Thomas' presentation. And sometimes these sessions remind me a bit of my time in school, right? Because the main instrument of education was repetition. So if you might hear some of those things over and over again, I don't think that's a bad thing necessarily. So I want to approach the topic from a slightly different angle. And I fully subscribe to all the things actually Emmanuel and Thomas said, but I want to give a perspective on the change management and strategy process associated with that. So the first step, and I thought about a picture to talk to you and give you a consistent picture on how to approach it. I discussed it with my team. I said, how do you eat an elephant piece by piece? They said, oh, that might not be a good picture. So we landed with a hike. Okay, so let's start a hike together and join me on the journey. And it is a step-by-step approach, right? So you're not gonna go on a hike doing all the steps at once. And one of the first steps usually you could reasonably do is map the terrain. So where are you actually going, right? So what is the desired place? So where do you want to be? But also what kind of characteristics are gonna await you there, right? So is it rough terrain? Is it easy going in the beginning? Is it gonna be steep? Those kinds of things might be really interesting. And as well, maybe weather conditions and stuff like that, right? So on our topic, the point, actually, we already discussed quite a bit. What kind of entities? Will there be resistance? I mean, I think Emmanuel and other colleagues drew a lot of attention to the point that this is about tightening control. And who actually will happily join you in getting tighter control on their operations, right? So there will be elements that might not be nice and sunny and rainbows all the time, right? So there will be rainy days, there will be storms maybe even. Also the question on the governance setup, and we had the point made that, you know, if you can't get the data, then probably you don't even have control. Well, that is not a good point to start from, right? So if that's your situation, then you also will need to carefully plan the route, right? So you're not gonna be able to go full storm to the entities and say, you know what, by the next year, starting with March, you're gonna be consolidated, period, full stop. So that, first of all, will not resonate well. Second of all, probably not gonna be able to pull that off, right? So it really is also a question of, and we heard that, maybe it's a multi-year plan, maybe you have a legislation which will put phase 1 into effect after 2 years, phase 2 after 4 years, and so on, to give people time to accommodate, to prepare, to build capacity, to build consensus. So this is really an important issue as well. And also on when do you actually need the information, right? So a lot of SOEs might say, okay, we're gonna give you the data once it's audited. And for one entity, that might be March. For another entity, that might be September. So if you want to have the same date and the same alignment, you might end up at the end of the year, you might end up in the next year. And if you need that information for your budget cycle, for your planning, be it annually or multi-year, there's no use having that information that late in the stage. So what you would have to discuss with the entities is early closings, moving those dates forward. And again, those are conflicts, right? You're putting another strain, another workload on the SOEs in order to get your information, and they might not like that. So there is really things to be considered, and I think the important point here really is to be very drastic in the picture, but don't bring a knife to a gunfight, right? Be prepared. So if you approach them, think about the backlash, think about what they might bring up as points why it's not possible. You know, if they say it's not possible, you can show them Guido's website and say, well, it is possible, apparently. So you can prepare yourselves, right? Find a strategy on how to approach them, expect the resistance in the right places. But also, and that's leading me to the next step, particularly when you anticipate bad weather, don't go alone, right? So find someone who's going to join you, and I have a strong suspicion that there are entities in the room that might be willing to go for a walk with you and in that regard. So it is really about anticipation again, right? So if people say, I don't have the capacity to do that, yes, I will do it, but provide me more budget, right? I mean, if you pay for it, I'm gonna do it. It's always important to have this kind of strategy already in mind to say, well, I don't think you have to do it alone, right? I might provide you a center of excellence. Actually, I might even, and maybe that's a practical element and a bit of an emerging practice, that you also use a lot the counterparty information in consolidation. So I've seen this in practice quite a bit. It's not only the chart of accounts, it's also the counterparty information, which sometimes is easier to access and easier to handle. So it's always this kind of having an answer to a question you anticipated early on. And also the question of the community of practice, right? So, I mean, what I've shown you earlier, the consolidation was 5 entities out of 183, and that goes back to also what Guido said, think about the Pareto rule, right? So there will be a big, significant impact of comparatively small number of entities. And if they work together, or if they kind of provide some insights for others who have to follow that path, then usually it's easier to do. And also I want to reiterate the point on that actually, that's actually leading me already to the next slide, but the more you walk, the easier it gets, right? So the hardest consolidation is the first consolidation. And I can tell you from experience, the team I'm working with in PwC, we are doing a whole lot of consolidations for the private sector. We have 5 people consolidating 12 companies on their own, basically. The toughest one is the first one. The second year, the third year, if you, and that's a really important point, if you stay connected to the entities. And I think also, Guido, you made the point that, you know, if you have a monthly or quarterly reporting, where you do understand, oh, there is a new type of transaction coming up, there is a new judgment you brought into the statement I'm not aware of, then it's much easier to accommodate than if you have everything at the end of the year, everything in the tight deadline. So it's really a question of how to approach that and give people time to learn it. I think it's I think it has been said already, but I reiterate that it's not an art. It's really you know, you have to learn that and you have to repeat it, right? So it's like if you want to, or if you have to get heart surgery, you don't want to have it from a person who does it for the first time, right? And it's very much the same with consolidation. Ideally, you want to have someone who has done it 20, 40, 50, 60 times, because then you have reliability and then you have also a much easier and smoother process. So there is a lot to be taken away from that. And also I think it's about mindset as well, because if you always anticipate this being hard and being nearly impossible, then probably you'll never start. But if you say, well, it's going to be the first year that's really going to be tough, and in 2, 3, 4 years, actually, it's just going to be business as usual. We're just going to do it because we are now used to do it. So it really, there is a lot of change management within the organization and getting people on the way to really try it and then actually get comfortable with the work and the processes. And I think last but not least, it's really important also if you go to a hike from time to time to take a pause and enjoy the view. So do celebrate successes, right? Either be it purely internally. I mean, honestly, I had a great time when I did the exercise because I came across so many things I didn't know, so many things I didn't expect. So that was great. It was enjoyable, to me at least. But that's important, yeah? So where is that piece of information you're generating useful and beautiful for someone, right? Because if you have that kind of milestones in mind already on your way up, then sometimes it's easier to keep going if you're fatigued or if the conditions are not perfect. And maybe also the last point is then just pointing out the new learnings and the capabilities you have. And I think this cannot be overstated, and that's kind of also my closing point a bit. We always talk about the cost of certain options, right? So what is the cost of consolidating 700 entities fully aligned with IPSAS? Yeah, that's a good question. What is the cost of a phased approach, only consolidating the 5 biggest entities with, let's say, not all of the IPSAS standards? Also a valid question. What we do not talk about is what is the cost of doing nothing? What is the cost of not knowing what your SOEs actually are doing? What is the cost of actually demonstrating by not being able to consolidate that you might not even have control, as Thomas indicated? And there is this saying that an Austrian psychologist put, I think, nicely, because he said, you cannot not communicate. Even by saying nothing, you give an impression to the other party, because there is no such a thing like non-behavior. And translating that into our SOE picture, that really means if you have fragmented data, you might create misleading narratives. If you have blind spots, you might create incentives for arbitrary behavior, right? But you can also say, if you approach it proactively, you show initiative, you show command of a situation, that also communicates, right? So it's, I think this strategic element is really, really important to consider. And when we talk about consolidation, I think we can have probably another session about the technicalities of it and how to approach it. But I think it's really, really important to understand that this is not just a technical project. It is a change management project. It is a strategic project, a fiscal strategy project. And I think it's the right composition in the room and of the institutions to have a conversation around that as well. So that's what I wanted to share. Thank you very much.
Thank you. Thank you very much, Thomas. This was excellent. And there's a lot of credit to your presentation, but at least one of them is to inject a lot of transportation metaphors in the way we communicate about consolidation. I count hiking, walking, medicine was involved at some stage as well. So we have a lot of metaphors to draw upon here. That's great. But beyond that, thank you very much. We now go into questions and answers. We do have some time. I do have a couple of questions that I'd like to get off my chest first. As I do so, please prepare your questions. And the first question goes primarily, but not exclusively, to Emmanuel, but I'd like our two other panelists to follow up. And that goes to the question the issue that you raised quite prominently, namely the alleged friction between competitiveness and compliance. We do have those of us who are working in the SOE corporate governance space. We adhere to OECD's principles of corporate governance, which talks a lot about autonomy, operational autonomy of SOEs. At the same time, we of course have a drive towards compliance under consolidated reporting. My question to you, I mean, how real is that? How concerned should we be, and what can we do to mitigate it? You did mention yourself that there's an issue of division of labor between the SOEs and the consolidation agency. You also mentioned issues of a sequenced approach. Is that how you see that this can be mitigated? And you'll have the primary opportunity to respond, but I'd also like to hear our two other panelists, since I did see a little bit of a reaction when you mentioned that. So let's start with that question first.
Thank you so much, Peter. So my point was really about the balance between the two, and there's probably not a one-size-fits-all approach to that. But I think we should all remember how SOEs in many cases came about in the first place. And the idea was sometimes to precisely take them out of the general government and make them more agile, make them more competitive, allow them to respond more quickly to market demand, to customers, to provide services, which is not necessarily always the primary logic that a public entity operates with. And I mean, if you look at some of the telecoms, for instance, some of them used to be part of a state. In some countries, you used to have the Ministry of Telecom over railways, and you have a few other examples. So what I'm trying to say is just keep that a little bit in mind and don't, through the consolidation, completely forget what you try to achieve with the SOEs.
Yeah, thank you for kind of giving us the opportunity to react. Actually, I was about to react on that when I was at the lecture, but then I said, okay, skip it. But now, okay, I go for it. To be honest, I was like reacting a little bit like that. If I hear this argument, we should not be over demanding in terms of reporting requirements, because there might be a loss of competitiveness. Because I think comparative competitiveness compared to whom? That can only be to private sector entities. And I think the let's say, the picture that private sector entities have less reporting requirements, especially if they are dealing with third-party money, not talking about being stock listed, is probably not true. I think this is exactly what they complain in terms of competitiveness compared to state-owned companies, that they have to follow these rigid reporting requirements, comprehensive reporting requirements, and state-owned entities in many, many cases do not follow these rigid reporting requirements. So just to put that in that context, but of course, coming from an accountability perspective, and you heard my first presentation, you heard my second presentation, I cannot say we should sacrifice compliance and a comprehensive picture on transparency and accountability for the sake of making them more competitive and say, okay, we reduce your burden and therefore you have it easier.
Maybe something I would add, but I think it was maybe from a similar starting point, like you, Thomas. But I think it's important to distinguish that, yes, the mandate should be independent, but that does not mean you're not accountable, right? So I am not going to tell you how to do your business, but it does not mean you're not accountable to me on how you do your business, right? So I think that's kind of the nuance. I think sometimes. And to the public, as a public owner, absolutely. And this was actually the second point I wanted to make, because also what I observe quite a bit is, like you said, I mean, sometimes there is a purpose, or always there is a purpose to have an SOE in the first place. And sometimes it's like an infant market or infant economy, where you try to get some capacity, some knowledge, grow actually a sector. But that might lead to distortions in competitiveness. And since you mentioned telecommunications, or also in Austria railways, at some point you might have competitors come in, but they lack the history, they lack the capital maybe sometimes, but for sure in many cases they lack the public sector element, like owning the infrastructure, right? So the one competitor is owning the infrastructure and the other one is only allowed to use it. And I think it's particularly instruments like reporting, where you at least have to be transparent about that public sector mandate and what it actually means in terms of service potential and what you will try to achieve. Because if you're silent and you're kind of implicitly saying it's part of our commercial mandate, then it's actually kind of you're distorting actually the market rather than helping it. So that's from my perspective, at least.
This is, I guess, the healthy friction that we get out of bringing communities together. And I do actually think there's a much more agreement across the board than we're indicating. I think you're, of course, not advocating for not being accountable, and you, of course, not arguing for not being competitive. So there's a middle ground. My second question goes primarily to you, Bernhard, but I'm also happy to have other interventions come in. That goes to the point that all three have addressed, namely this journey, hike, pilot, driverless cars, we can call it wherever, but at least you have to start somewhere on this journey. And we have to be aware that when it comes to SOE consolidated reporting, it is not a practice which is widely observed at all. So how to get there? And many countries, some countries in the region, I think a handful or so, do what is called aggregate reporting, namely putting together aggregations of financial performance and non-performance of the SOEs into what is called an aggregate report. You mentioned that, Ben, as well. I wanted to have you elaborate a little bit on the extent to which this is the right step in the right direction, and if that is correct, what colleagues and governments should be aware of as they take these initial steps so they are consistent with the final destination, namely consolidation.
Thanks. So I would probably start with my last message on the slide, right? So you will send a message by aggregating rather than consolidating, and you will send a message by aggregating and not showing anything at all, right? So if you want to have this kind of gradual element, I think aggregation does send a message that you are aware of the universe as a population. I think that's, and everyone in the population might have a practice, but you're not giving insights into whether the practice is comparable or consistent. And particularly, you're not pointing to what are the risks associated with those practices. So yes, it will provide you a picture, but I think there is a a very strong risk of overselling the picture, right? Because you might people might be inclined to make conclusions on the aggregation. They might not make, if they have really the consolidated picture, where they have the eliminations, where they have the consistency of application of accounting policies and elements like that. And the last point I would try to make is, again, probably what is the question, why, right? So is it because you struggle to get the information? Then I would be concerned, right? Because then we still have the question on whether you actually have control. Or is it really only the effort? And if it's only the effort, probably, and again, Thomas, you already made the point, you can fairly challenge that and say, well, in other cases, you're not that hesitant with efforts, be it the private sector or maybe the citizens doing a text file or something, right? They also all have to go through effort. So why is it this segment that not has to go through the effort? So I think this is kind of how I would approach it.
Yeah, if I can add to that, and probably my answer is not surprising, as I said that already in my first presentation. I think one aspect is certainly that kind of the whole thing about intercompany transactions, intra-group transactions is completely ignored in that, which might kind of be expanding the whole picture of not only kind of the performance, but also on other sides like receivables and liabilities resulting from that. But more importantly, I think I would want to touch on one point. If aggregation should give like any, or should have any value as an intermediate step, then this total needs to be meaningful. This total is only meaningful if you have a comparable data structure and if you have unified accounting policies. Otherwise, you don't only add apples to pears, you have a full fruit basket. And the question is, what informational value has this total under having added up all different accounting frameworks and financial statements being prepared on different bases? I couldn't even imagine what value that could have as an intermediate step. I think getting the parameter, getting an overview about the landscape as a very, very, very first initial step could be helpful. But then I think you need to think about kind of how do you make the data comparable in order to add it together anyway. And then you're halfway through to consolidation, because then it's only eliminations lacking, missing.
Brilliant, thanks a lot. And also for adding another metaphor to our, now we have fruits added to the fruit basket of reporting. My last question goes primarily to you, but I'm actually keen to hear also the panel elaborate on that. And after that question, we will invite you all to ask your question. That, Thomas, you're also quite clear on emphasizing the need for piloting, and so were the other panelists. Could I ask you to elaborate a little bit about the criteria that you suggest or propose that are used for piloting? Is it a function of size of the SOEs? Is it a function of existing qualities in reporting standard? Is it a question of commitment? How would you, if you were to advise these governments to let's get going with a pilot approach, how would you cut the cake? And I'd like Thomas to answer first, but if the two of you could elaborate further on the specifics of getting started.
Yeah, I think that's a great question. Which entities to identify for such pilot activities? And actually, I think at least to my experience in countries where we accompanied accounting reforms in the past, it was very obvious because these entities were already asking for, can we please be included? And why have they kind of been asking for that? Because they have been kind of understanding the purpose of the whole exercise. They had been very mature in their accounting kind of preparedness, let's say it for that. And they have been very closely connected to government and on communicating on a regular basis, which is already a very good precondition for the consolidation exercise in general. So I think that has been the three criteria. On the other side, I would not necessarily say you need to start with a very big entity, because very small entities can also be very interesting when it comes exactly to this aspect of how do we avoid overburdening demands for data and providing data. Different sectors could be interesting because different accounting requirements might apply to different sectors, and how to translate that in a kind of a reporting package, as I said that earlier, and how do you provide and present this information afterwards in order that it still remains transparent from which sector, from which activity of government does it relate.
I fully agree. I think particularly on the points of maturity and significance. And I mean, the way I would approach it is to really think about what is the problem. So basically sit down with your SOE and ask yourself, in our relationship, what was the most annoying thing that frequently happens, right? I'll just give you an example. I mean, we had, I mentioned the railways a couple of times, one of the biggest significant SOEs in Austria. And each and every minister of finance tried to reduce the transfers to the SOE because it's really a very large amount of the budget. But behind the transfer to the SOE is actually the investments they made, the loans they took out on the capital markets to do the investments on behalf of the government. And they're basically now only repaying the loans. So there's nothing to reduce actually from a budget point because it's just repaying loans. And that was frustrating for both of them. Right? The Minister of Finance tried to find some spending room in the budget, got frustrated because there was nothing to find. And the SOE, the railways, got frustrated because everybody was questioning their transfers instead of seeing actually that they build infrastructure by taking in loans, right? And if you would do the consolidation exercise, that would be exactly the picture that would remain. You have constructed infrastructure and you have taken out loans. And therefore, it's a non-budgetary issue, if you want to put it like that. I think finding those commonalities and saying what is annoying about our relationship, and maybe we can fix it by consolidation.
Thank you. So I would add to all of this that some things you really start by doing. And I think that's really also the value of the piloting, that it actually shows you, okay, in what direction are you going? And don't be too perfectionist in the first attempt. I mean, I think we all appreciated the small, quick exercise that Bernhard did for Austria. Already that, it may not be perfect. Nobody may want to sign and, you know, take the liability, but just to get an order of magnitude, what are we really talking about? What are some of the potential impacts? And then also, don't be afraid to make some mistakes for the first time. It's really the reference point, also maybe teasing out some of the issues, and that others can say, oh, this is not right, and maybe we could do it better. But I consider all of that to be part of the process.
Thank you very much, all three panelists. So I hope there are now some questions from the audience. We'll take maybe 2 or 3 to begin with. Do we have walking microphones that can support? I have Ukraine here, and then I have our neutral observer down there, and then I have also from the table behind. So please, you go first, and then we have Tajikistan, and then we have WorldBank colleague.
Thank you very much for your presentations. Thank you very much for your presentations. You said that hiking up the hill or driving along highway requires good vision, transparent information, and consolidation of state-owned enterprises allows to understand real potential of every enterprise. Emmanuel said that every SOE has its own history, and it's good if this SOE or municipal company, it's good if the state owns 100% of the enterprise. But what if this is a private company with significant investment from the state, say 50% plus? So how do you consolidate companies if local government or national government has controlling stock, but there are other assets that belong to other owners, other investors. Did you pilot on this, and how complicated was that? Thank you very much for very meaningful presentations. I'd like to point out several things. Emmanuel spoke about commercial SOEs. We also have this approach that commercial SOEs are like government companies that work in private way. So there is a way of consolidating them. But I have also a question to Mr. Thomas. How do you prepare financial reporting of these companies? Of course, if they report according to IFRS, then how do you consolidate them according to IPSAS? Because we have these problems with SOEs that prepare reporting according to IFRS. And most difficult issues are related to taxation of these companies and assessment evaluation of their assets. How do they do consolidation? Because valuation of non-material assets would be different for state-owned enterprises and private companies. And Bernhard said very well that it's not about art, it's about practicing. And we as auditors, we need to advise how to prepare consolidated reporting. And so far, we are saying you have to have two sets of reporting, one for IFRS, or the other for IPSAS. But how can you make one report with both IFRS and IPSAS?
Thank you. Yeah. Thank you very much. And I'll take the two last questions now. We had the one from the WorldBank table, and we have one from Georgia, and then we'll go to the panel.
Thank you. We've been performing a number of ROSC lately, and we do look at SOEs financial statements. And the last three ROSC that we did, where SOEs are using IFRS for their financial reporting, we found that they were significant less quality in SOEs than in other companies. And it's not only that audit report have modified opinion or disclaimer of opinion. It's actually the quality of the financial statement is not good. So what consequences for the consolidation? So that's a question for you. And I would like also to offer a small comment, which is aggregation is not a practice that is I would say that has specific rules. It's a good step. Now, it doesn't preclude governments not to do elimination of intercompany accounts. Most of the countries don't do it, but it would be a significant improvement to have it. Thank you.
Very good point there. Thank you very much. And lastly, Georgia, and then we have another follow-up from Tajikistan, but I have to encourage you to be relatively short. And also Albania, since we do have a panel with some very tight deadlines. So please, Georgia.
Thank you. I represent the Treasury of Georgia, and I have a question about aggregation. I so understand that when we talk about consolidation of SOEs, it so happens that every separate SOE should be consolidated, but we talked about different standards, various chart of accounts and so on, various standards. But how can you aggregate all SOEs? Maybe there should be gathering all SOEs reporting financial indicators, exclude internal operations, and then consolidate all the reporting. So how can this be done on national level? Because we want to see how these SOEs impact the national budget overall. So we are not so much interested in financial indicators as in impact SOEs have on the national economy. Then there are some situations when SOEs receive public assets for their operation. How is it? How are they consolidated later?
We're taking good notes here, and it's a good set of questions. The panelists can already begin to prepare their answers, but I want to take the two last questions very quickly, and then we'll give you a minute or so to respond. We will have Albania here first, please.
Okay, thank you, everyone. Thank you for the great presentations. I do have a short question, and I think relates with the presentation of Thomas, mainly with the last part of audit and the cooperation between the SAI and the auditors of private sector, especially when they audit the SOEs, and sometimes they do come with different opinions and conflicting opinions as well and findings. And I don't know, it would be very good to know what are the best practices in this regard, how we can reconcile these opinions as well. So this is also a very important part, I think. Thank you.
It's a question I'd also like the answer to, and it's something that we are exploring. So I just put in a small advertisement here that namely later today and tomorrow you will be discussing future work programs, and this is certainly something that we're all interested in knowing more about. Last but not least, can I kindly ask the gentleman to be relatively brief in your question, and then we'll go to the panel for responses.
Thank you very much for the informative and very comprehensive presentations for all the speakers. My question is about the methods that should be used during the consolidation. At the first part of our today's discussions, there was a question of the shortcomings and the advantages of the line by line and equity method consolidation. When it comes to the budget sector, the budget entities, they got the same, the unified chart of accounts, and they use the same standards. And when it comes to the SOEs and they got the different chart of accounts and different standards should be used. So the question and the answers of the speakers was that using the equity method is a shortcoming that we may, how to say, omit or information that it's not the complete information. So my question is, when you, for example, currently we are not prepared, including the SOEs in our aggregated, let's say, financial reporting in our jurisdiction, but when it comes to include them in our reports, so can we use the equity method, and what's our, how to say, shortcomings and advantage of these methods? Thank you very much.
Okay, we're going to take a few minutes of your lunch break here by inviting the panel to respond to these 6 excellent questions, which actually spans very well the issue that we've been discussing, namely the issue of control and inclusion of minority positions, the issue of accepting various standards as one moves towards the best practice, but also issues on coordination. What I will do now is a little bit of an ungrateful task, but I'll actually I'll give the panelists each 2 minutes to randomly pick off the very good question we've had to respond, and I encourage the other panelists not to respond to questions which the previous respondent have addressed. So first.
Yeah, thank you. It's great that you have an overview about what the questions were, because I haven't actually. I just want to start, as it is very close to my heart, from my auditor's hat, to start with this question. I think best practice in terms of coordination between the SAI and the component auditors, the auditors of the state-owned entities, is actually what we can observe in the private sector. And this is kind of working on detailed audit instructions, having clear communication calendar, having clear kind of messages of where does the SI see the material risks and focus areas for auditors. And how do you define materiality and allocate materiality to the SOE auditor? I think it has been proven to be the biggest reason for failure and audit deficiencies from a group perspective, to be not connected and not being sufficiently communicating to kind of component auditors. So that would be number one. Randomly pick, you said. Then I go to Ukraine. Just to say that I don't want to go into too much technical detail, but if you kind of own the majority of shares, but you do not own 100%, then you still practice line by line 100% consolidation. But what you have to do is then to show the minority interest in equity and the minority share in the kind of profit and loss of this entity kind of being included in the consolidated financial statements at the end. So this is not an argument to say I'm kind of using at equity method. I'm not using line by line, but you have to show then what is the kind of share of the minority interests and minority shareholders. So I think my 2 minutes are over.
So I'll try to actually do it clockwise, because that's how I try to remember it. And maybe I'm just going to give a little nuance on your answer, Thomas, if I may, to the Ukraine question, because what popped into my mind was, well, yes, majority share is a strong indicator for control, but doesn't necessarily constitute control. So it really depends on the bylaws. And if you are looking at this more on an investment side of things, and it's actually pretty clear that you can't, exercise control, then you might be in a different IPSAS standard. So I think the question is, why are you having such a significant share? And what is the actual rules to that share, I would say. Then there was the question on, I think Tajikistan, on the IPSAS IFRS, do we have to have 2 reports? And I think I'm going back to your slide, Thomas, where we had the column of adjustments. And I think in IFRS and in IPSAS, and hopefully Ross acknowledges that, there is a lot of permissibility of IFRS accounting in IPSAS. So you do not have to have necessarily a lot of adjustments. So it's really about where of those elements do you have really an adjustment and highlight those. So it's not kind of trying to think about each and every single transaction, whether there could be theoretically a difference to IPSAS. It's more the question, can you do that under IPSAS? And usually in many cases, yes, you can. So that might be helpful. Maybe on the question of the IFRS quality and the audit quality, maybe I'm just quoting a colleague of mine when we discussed sustainability reporting in Europe. And we were wondering, how are we going to come up as an audit profession with reasonable assurance or limited assurance on first-time adoption of standards? And a colleague basically said it reminds him of applying IFRS for the first time in Austria, where we signed off on accounts we wouldn't have signed off today. Exactly. So I think it probably is a question of maturity. I agree. But increasing that with the maybe Capital Markets Authority, the oversight bodies of the auditor, so it is a journey. Maybe on the question of the aggregation on the significance for the budget, I think, honestly, if you are really concerned about the budget, I think consolidation is really the only way to go, because it will show you what of the liabilities you are seeing in the aggregation actually does end up in the government accounts, and what kind of the revenue or assets. So if you're really looking for the budget, I think consolidation would be key. And on your answer to Albania, I don't have to add anything.
Thank you. I think most of the points have been covered. I just wanted to pick up maybe on Pascal's question on the quality of the financial statements of SOEs, that there are sometimes not as maybe elaborate as in the private sector. And I would add to that, from my own experience, in some cases, you don't even have any financial statements of SOEs. So for me, the implications of that are very clear. You really have to improve the accounting and reporting of SOEs. And I think we're well placed with this audience in the room. If that's an issue in your country, that should really not be acceptable, especially for the larger entities, and we should make a concerted effort to improve that. And then maybe just one last point on this impact on the budget, on the fiscal side. I think it's extremely important, and that's also another reason for the aggregation or consolidation. We all know very well what's our budget deficit, what are the growth numbers. So there are certain things we know for every economy, every single country. But it happens quite often that countries cannot really tell what's the impact of my SOEs, not even to the extent, are we making losses? Are we making profit? What are the dividends? And I think on that, we can be a little bit more ambitious. And that's also where I think the state control and really the accountability comes in, and where we can require certain minimum reporting on the side of the SOEs.
Thank you very much. I think we're coming to the end now. I'll end with one of Bernard's excellent metaphors, that this is indeed a journey, but it's also one which is better done together, and occasionally one should stop to take the view of how far we've come. And I got to say, with this panel and with your questions and with these kind of questions still in the air, I'm very encouraged about this group, together with other COPs can move forward and address some of these very exciting challenges. I want to thank the panelists very much, and for your patience, for your good questions, and give the panel a warm hand of applause.
Good afternoon, colleagues. We are ready to start our afternoon sessions. I hope you all had a good time in the lunch and doing a lot of networking. This is something that it's unique to PULSAR events. It's full of opportunities for networking and hearing of peer learning experiences. During this afternoon session, the first one, we will explore budget reporting and financial statements aggregation vis-a-vis consolidation, and we will discuss about the alignment of different reporting mechanisms. For that, we will explore how this has been done in two countries, in the UK and Estonia, the cases that you have heard during the morning, but we're gonna go more in deep to the tips and tricks, what to do, what to avoid, more practical examples. And we will dig deeper also in subnational governments, which was not so much developed during the morning. Our panel now, and you have noticed that now we have some representation. I'm sorry that the panels in the morning were hard to arrange with adequate female representation. So we are starting to do the right thing now. Thanks, Manju, for joining us in this session. We will have Jan Murray, Director of Public Financial Management at CIPFA, and Manj Kalar, who is a highly experienced IPSAS expert and with a lot of experience in the consolidation of the whole of government accounts in the UK. And Guido Big, that you all know, and which experience we are all very keen in the PULSAR family, to also walk us through more in-depth discussion on the practical aspects of what worked in Estonia. So I'm gonna give the floor to Ian to start with presenting the framework, and then we're gonna go on the specific discussion. Thanks, Ian.
Thanks, Jose.
Okay. If you see that it's not working, we will switch to this one.
Brilliant. Thank you. So good afternoon, everyone, and welcome back after lunch. We call this one the graveyard shift in the UK because all the blood is in your stomach. You're processing all of that lovely food. We'll try and keep you going and get you through the afternoon. So I wasn't proposing to speak for my allotted time, and that's mainly because I'm very aware that I have slight imposter syndrome sitting in front of you today, because I've got Manj and Guido who've got some really good first-hand, hands-on experience to share with you. So I think my job is maybe to do a bit of scene setting, and then I also want to share some work that we've been doing at CIPFA recently, some work that we published last month, where we're particularly thinking about financial planning and budgeting in a slightly different way. So I think there's this public financial management utopia where we have absolute alignment between budgeting information, financial reporting information, and statistical returns. And I suspect, like all utopias, it's something that we'll all strive for, but life is complicated, what we do is difficult, and we'll never, ever get there. But it's always worth striving for perfection, even if we know we're never going to get there. So it's completely understandable why that outcome or that scenario is desirable. And we've already explored a lot today, some of the pros and cons of consolidation versus aggregation, and particularly, and it's come up a number of times actually, particularly some of the advantages that consolidation can provide when we're thinking about budgeting, when we're thinking about financial planning, and particularly looking at that holistic picture of how we allocate and use public funds. But sometimes we don't want to see that holistic picture. Sometimes we need to think about different users, different decision makers having different needs. So I'm hoping that some of you, when you first saw that picture, can see a bird, and I'm hoping that some of you, when you first saw that picture, can see a rabbit. And each of you will have different perspectives, and each of the users that you're serving will have different needs and will want to answer different questions at different points in time. And this can create ambiguity at best, and at worst, it can actually create a complete lack of transparency. But at CIPFA, we really think that ambiguity shouldn't stand in the way of progress. And consolidation at its heart is that question of subsidiarity. It's about, and that question, those considerations apply more so actually when you're thinking about who's making the decision, what's the decision being made, and who is accountable for what. And I think when we start to talk about what services are delivered at a central government level and what services are delivered at a subnational level, that's a really important consideration. So what we need to be able to do then is thinking about how we can cut the same information in different ways to answer different questions. And it starts to raise some really interesting thoughts about segments. So I think segmental reporting has already come up once today. And whether they always provide the best lens through which to think about policy choices, and particularly as we start to think about emerging issues or new issues. So if we think about things like sustainability, or we think about public service reform agendas, often they require a cross-government response. And so some of those traditional approaches to segmental budgeting or segmental reporting, they're very good at telling you about what's happening at a service level, but they don't necessarily lend thinking at that outcome level. So what is it that you're actually trying to achieve with those public funds? And so that's one of the things that we've been grappling with at CIPFA, and excuse me, and with our partners at the Health Foundation. We've just been doing a piece of work looking at prevention. So looking at how money is spent in UK local government, and we've done 5 case studies looking at place-based decisions, but starting to think about if you were looking at some of that spend, particularly looking at investment or business cases, how might you start to tag and map that spend differently so that you can think about how you can answer a different set of questions. We've started with, you've got to start somewhere. I think we've had that one today already. And we've deliberately started by looking at this through a financial planning lens, But we think, well, we know that eventually we'll also build that out to start thinking about what it looks like from a reporting lens as well. And like all good frameworks, like all good, all well-intentioned things, the key barrier we see in the first instance is that we have to we either have to re-establish or we have to be clear about definitions. So one of the challenges we see is that people count things differently in different spaces, and then when you're trying to take that holistic view, it's really difficult because you're not all speaking the same language. There isn't that common understanding. So that's where we started. I won't read them out, but these were the 3 definitions we came to when we were thinking about preventative spend in the UK. And so this is about how we start to, rather than dealing with the symptoms of some of the challenges we have as a society, how do we get upstream from some of those things? And what's encouraging about this as an approach is that actually we're using really well-established financial management techniques to do this work. And I think this is where, as finance professionals and as accountants, we should take, we should be very proud of the role and feel empowered in the role that we can play, because effectively what we're doing is we're using established financial management techniques to look at a problem through a different set of lenses. And I'm not going to, this isn't rocket science, as we often say. Some of these are very familiar things that you would expect to see in any setting. When we've done this work with the pilot sites, we've been really clear about the focus areas. So thinking about the outcomes or the services or the cohort of the population where we're trying to answer those questions. Thinking about the services that they use and not thinking about the first line of service provision, but also thinking about what might the other things be. So if we're looking at health and well-being outcomes, they may not be just in a health setting or a care setting. Actually, a lot of those predeterminants happen in education. They can happen in housing. They can happen in other spaces. So trying to take step back and look at all of the services that might impact on some of the outcomes we're trying to achieve. We've been really clear about how we then classify those the spend within those services, and increasingly, and I'm going to reiterate this, and I think this has come up again during the day. We think that when you're doing these sorts of exercises, whether it's financial planning or financial reporting, consistency is more important than precision. So long as you can be consistently applying those principles in the setting, that's more important. You'll get to, what did Bernard say, that it's better to be near enough right than completely wrong. And so that's, again, a really important concept, which is you won't get this 100% right. There's no such thing as a perfect set of financial statements. There's no such thing as a perfect budget. So consistency of approach is more important than provision. And then finally, having done that mapping, we tag the financial information. So this is what we've been doing. It's very early days. We've seen similar approaches used for things like green budgeting, so addressing things like climate change. And what we're trying to do is, I think Guido said it, and I don't want to steal too much of his thunder, but he was saying that actually politicians spend an awful lot of time thinking about the budget or thinking about the plan, and we don't spend enough time often thinking about the outcome, thinking about the, reflecting on the performance. And what we think then is that this is potentially a way to engage politicians and other policymakers in some of those important conversations. Because I think once you've been through this exercise enough times, it doesn't take too long before someone says, okay, so we've done all of this hard work now to work out where we're spending money, what we think the outcomes that is generating. How do I know? How do I know the answer to that question? So I actually think through financial planning, we can start to engage people in the journey towards financial reporting, because I think these are the sorts of questions that do excite politicians. This is what, they want to use public money to, well, hopefully for public service, if not that, then at least to get re-elected. So I think through financial management, you can start to push at that financial literacy. You can start to push at some of these things. And I don't want to dwell on this too much because these are specific to this project, but I do think some of these read across in terms of some of the conversations we've had today about the benefits of consolidation. We think that it's really possible, it is possible to quantify, use financial information to quantify new and different things, but you can do that using tried and tested techniques. Collaboration is absolutely essential. This work has involved the finance community, but we've also had to engage policymakers. We've also had to engage frontline service delivery. It's been great in the places that we've done it to build a shared understanding. So, and that's incredibly important. And it's really, where we've seen this work in local authorities, it's also embedding those things in strategy. So if you want to affect change, then you need to put that at the forefront. You have to do that intentionally. It has to be done as part of your strategy. It can't just, it's not just going to happen if you leave it to chance. And it's also been very powerful in terms of understanding some of those wider bits of the public financial management machinery, understanding how some of those enabling services are really important. So I'm going to pause there because I know that Manj and Guido have got some hands-on things to share with you. But from my point of view, I think what the piece of work we've done highlights is that you absolutely, if you want to start somewhere, if you want to win if you want to make a case for change, actually using some of those tried and tested techniques, using some of those things that you will be doing, but approaching them in a different way can quite often help you win that argument further down the line when you're talking about financial reporting and performance. And I think it's really exciting, some of the things that we can do when we start to think about how budgeting, financial planning and financial reporting, when we're looking at both sides of the coin, that's the utopia. That's how we get to affecting changes in the places and for the citizens we serve. Thank you very much.
So we're gonna go with Manj to hear about the consolidation in UK. Oh, do you want to use it?
Okay, brilliant. Thank you. So good afternoon, everyone. Did you enjoy your lunch and did you network? As Ian has just said, yes, this is definitely the graveyard shift. The food is settling. Hopefully we can get some energy going in the room. Thank you so much to the World Bank for inviting me once again to speak to you. And most of all, thank you for giving me your time and attention for listening. So what am I here to talk about? Well, we've heard a lot about the why, and I think you can all agree that the case for why has been well made this morning. I love Thomas's slides on that, reflecting on the financial statements. They're both backward-looking in respect of delivering accountability, but also forward-looking in terms of decision-making. And that's the win. It's really making sure we're using the information. So we want to have good information. And I love Ross's last slide on the glasses to provide that clarity, except you have to put the glasses on to get that clarity, right? Make use of the information, but don't wait until the end. Wherever you are on the journey, start to use the information. It creates the demand for information and therefore creates that virtuous circle. The more you give, oh, I didn't know I could get that information. Oh, that will help me. You can see why, and it will then support you. For those of you on that journey, it is a long journey, don't we know? It's for your own motivation, but also for the motivation of people working with you. The so what, don't wait to the end. Otherwise, you will suffer reform fatigue, and it's frustrating for the people working on the project or working with you. I'll always share the lessons that we learned, both positive, and please do not repeat these mistakes from the UK experience. So I always say, yeah, and the final point was, there was a point just made just before the lunch break. Yes, there is absolutely a tension between the cost of compliance. We spend over 100 million, just the NAO, the Supreme Audit Institution for the UK, spends over 100 million on the audit. of these financial statements. If the data isn't used, what is the point? That's £100 million that could be used somewhere else. And that should be the challenge to all of us. Anyway, so knowing the why is your guiding light. It's not a train coming down the track, it's the guiding light as to where you want to go. So Ian really set out this morning the UK context. And so the question is, are we there yet? Well, you decide after the end of my session. The UK public sector is highly centralised because UK central government will tell local government and other parts of the public sector what they have to do, how they have to do it, and the funding. That legislation and funding slide that Ian used this morning absolutely covers it. Because of that, it has to be included in the consolidation. You think, but Manj, we were talking about state-owned enterprises. Well, actually, central government was the last to the party to come implement accrual accounting within UK government. State-owned enterprises, straight from when they were privatised, public corporations were following IFRS. Local government follow their own code, which I discovered because I worked in central government for 18 years and realised when it came to doing the whole of government accounts consolidation, what? Local government do something different? We don't set it. It's not covered by the financial reporting manual. And then I had to understand the why, and it all links to funding. So it's highly centralised because central government tell them you have to deliver social care. That is the most pressing issue in terms of a demand-led service for adult social care and children's services. But because it's demand-led, pressures are really, really high, and we have to look at the finances. Understanding that is the key. So the first step was, what we did was a staggered approach, a step-by-step. I preferred Bernard's metaphor for a hike rather than an elephant, eating an elephant, particularly because I'm a vegetarian. Of course, that would make sense to me, but step by step. So in 1996, I was coming up to doing my final exams at that stage. I know, I was a protege and I went through my accountancy, my degree quite quickly. No. I was doing my accountancy qualification at that time, and we were looking at the development phase of accrual accounting. So central government was moving to accrual, and in 2001, we delivered. Then the central government entities were looking at central government and their agencies and the devolved administration. So Welsh government, Scottish government were looking at developing their consolidated whole of government accounts data. Between 2004 and 2007, that's when the wider public sector was being brought in, looking at local government, NHS, public corporations. I call step 4 to 2007-8. At that stage, we're also implementing IFRS, etc. We're friends here. Shall I share? I was in a meeting room, probably the most junior person there. My boss leaned over. Manj, they keep talking about Alistair. I don't see an Alistair in this room. I leaned back. I think they're talking about the Chancellor, the Finance Minister, because we could have been ready to publish at that stage. Don't forget the politics. At that stage, we would have published the whole of government accounts. Were they ready? Not really, but we were thinking, let's not perfection be the enemy of the good. Let's get something out there. 2008, you'll remember something happened around then? The global financial crisis, sovereign debt crisis. You can imagine the impact on the UK government balance sheet. Did we really want to publish data that was showing that UK government owed more than it owned? Owed more than it owned to the tune of £1.2 trillion. How were the markets going to deal with that? So we had to work with the markets. Anyway, So I'll share with you. So we were kind of ready, but we worked on finalizing getting the data right. And the first WGA was published for the financial year end 2009-10. So since then, when it started, it was 1,500 entities. I was responsible for 483 local government bodies. Consolidating, it was just me and one trainee accountant. It is doable. I'm not saying it's easy. And would I have accepted the role if I knew then what I know now? Who knows? But so since then, it's grown from 1,500 entities to now over 10,000. That's with the central government, the agencies, public corporations, NHS trusts, local government, academies as well. So schools. In UK, central government directly fund schools. Because of that, they're in the central government, they're consolidated. So the 2023-24 was the 15th WGA publication. And let's address the elephants in the room. Between 2009-10, all the way through to 2021, all the financial statements were qualified. That might be a surprise, maybe a surprise to some of you, but maybe not to others. Why were they qualified? Accounting boundaries, control. Now, this is where I take it back to Thomas's question about classification. Would we have started where we thought where we started? No. But we ended up in a position where, for very good reasons, I think, UK central government decided, or Ministry of Finance, Treasury decided that they wanted to follow the ONS definition of the boundary. That is not the accounting definition of control. So some entities were included, others weren't. Over time, now that was a deliberate decision. Then, well, you say you're one of the leading lights and you've published all these financial statements, but they fundamentally, we are qualified because we don't follow the accounting definition, the principle of control. Well, why do you do that? We do that because what we wanted to show is, look, the statistical reporting shows this data, but look how much extra you get, because you're comparing, what's it, Thomas's fruit basket, you're comparing apples and apples, not apples and pears. Okay, so, and unfortunately, you think after all these years, we'd have enough practice that we'd get it right, and we wouldn't have, you know, after qualified, you hopefully get to unqualified, right? No, for the last 2 years, we've had disclaimed audit opinions, so it's gone the other way. Why is that? Because there's lots of missing data. Loads of local government entities could not get the data in time. Some central government entities too, whereas before they were delivering it. And that's for the last 2 years. There has been some, central government have put in this backstop with audit, etc. That's got to work through and get rid of these qualifications to bring them back up to speed post the pandemic. But even so. So we've got 15 years of experience. We've always had qualified opinions. The last 2 years were disclaimed. You're probably thinking, well, get off the stage, Manj. Why are you talking to me about the UK experience if it's so, it's not getting better, it's getting worse. This is the last one, the one that was recently published. Forgive me, you'll have the pack. Also in your pack, there's links to all of these documents and others as well, which I hope you will find useful. But you can see over time, the total assets have increased. And that's a key thing. You've got a lot of trend data. Trend data is insight. What's happening to my property, plant and equipment? What's happening to my total liabilities? When we were first publishing the financial statements, it was 2.1 trillion. Do you remember I said, and we were nervous about publishing that number. Today, it stands at 5 trillion. That's how much more UK government owes compares to what it owns. That's probably shocking numbers. And most of that, 2 billion, is government borrowings during the pandemic and otherwise as well. They're still continuing to borrow today. That is information in the handbook. Another quick tip before I go into the detail of what I did. Firstly, the WGA, if you want to read it in all its glory, I would encourage you, having worked on it for so many years, it's disappointing when no one actually looks at it. Even today stands at 318 pages. So the first time ever, the Treasury have put out this short handbook, which is only 24 pages with key documents, key data in there. So do have a look at that. Anyway, so what was the approach? I always love Stephen R. Covey's comment, his 7 habits. The 5th one, this is where I start with. Seek first to understand and then be understood. I suppose 2 as well. Begin with the end in mind. What is it that you're trying to achieve? But don't lose sight of the journey. So seek first to understand. So what did I do? First thing I tried to do was really to engage. Talk to Treasury, National Audit Office, where are the problems? What do I need to do? And talk to local government. How was I going to get the data from them? If you understand, in the engagement phase, it was about learning the landscape, the different financial reporting frameworks, the different chart of accounts, because they were told by CIPFA in terms of how they had to publish, and to compare all local government entities, they could compare one local government entity's set of financials, income and expenditure, statement of financial performance, with another. So you have this CIRCOP, and you also had the code, which is, so I used to always approach CIPFA that's probably about this time of year, and I say, please, could I have my Christmas present? And they say, what do you mean Christmas present? Because we used to have to buy the code and the code guidance notes. From there, I created a WGA data collection toolkit. It was on Excel. So I'm deeply jealous as to Guido showing us his online tool, which you'll see more of, whereas we just had an Excel spreadsheet. Well, I developed an Excel spreadsheet for the accountants in the room. Hey, we couldn't prepare a set of financial statements without an Excel spreadsheet, could we? What we did was so what I did, I made the front end look like a local authority set of accounts. If I made it look like central government, they wouldn't have understood it, like I didn't understand local authority accounts. So this is where, and then we did mapping. So Thomas talked about classification, and then he talked about mapping. One big regret is that we lost a lot of that transparency, that wealth of data we had for each class, strictly shown by CIPFA's CIRCOP as to how to classify each of the income lines and the expenditure lines. It all got lumped into one: purchase of goods and services. We should have insisted on having separate, because that was so much data that we lost, that insight we lost. So do think about that with your chart of accounts when you're setting it up. But anyway, so I developed the spreadsheet. I made sure that we had clarity. I used to say, I know this is hard, and I was honest with people to say, look, I need the information from you. What do you need from me to make it happen? Will it be useful to them? That was the question. Directly? No. It was not at local level, but at macro level. Yes, it was important, but not at local level. So I think they appreciated the honesty in terms of what it meant. So what we did was take the financial statements, and if there was a note, for example, I'd only say, I want you to give me the data once to save your time. For example, the depreciation charge in your property, plant and equipment note will be the same as what's in the statement of financial performance. right? So I used to automatically lock it. My balance sheet was auto-derived, statement of financial position for you young ones in the room, so that I had lots of controls within the data. So we developed the tool. I co-created and tested it regularly. So I had a group of 30 local government bodies, representatives, to test what I was doing. I know that Ian says he felt like a fraud talking about the practical. I completely felt like a fraud because I'd never closed a set of local authority accounts. And here I'm talking to over 1,000 people where I was doing training to how to close local authority accounts, never having done any. So you can imagine the imposter syndrome was very strong present there. Align resources. Look, it was only 2 of us. How did we do it? We made sure the people who were collecting the information centrally for the statistical data, I used to borrow them. I used to ask people from local authorities to join us. They could see our process. Equally, we could share with them and we could deliver training and support. So you don't have to do all of it yourself. Think practically. Provided training and online support. And it's not an area that's been discussed a lot, but I will tell you, one of my biggest headaches were the intra-government eliminations. They are so difficult. Let me give you the context. I had 6 weeks to get all the returns in, get them uploaded onto the system, check them all, do the eliminations, 6 weeks for all of that, and then help Treasury to do the central government to local government. This was, yeah, I can tell you, it was a real, camped out work for 6 weeks. That's how it was, and that's how it was delivered. It is, so my biggest thing that I was trying to do to make my life easier was to make identifying and recording intra-government eliminations as easy as possible. I set up a website for each government department. So the Department for Education will give money to schools. I just had a drop-down menu for each school to say, can you give me, so that local authorities can select to say, this is how much they think they've collected and collect it. And that's what they're saying, is that what you've recorded on your financial statements to try and make sure the eliminations were as smooth as possible. Okay, tips. I don't know how long I've spent, so I'll carry on. So tips, 3 broad areas. Firstly, I would say assess your current reporting requirements. What's your gap? Now, some of you and this applies obviously with state-owned enterprises. Some state-owned enterprises, as the conversations and the questions have come in this morning, they are based on IFRS or different national standards. That's fine. Central government might be doing something different. Municipalities, local government doing something different again. So you need some sort of bridging tool. That's what my WGA was. I had their chart of accounts. Everything was visible. I showed the mapping to local government, to central government chart of accounts. So it was very clear to see what we were doing, how we were doing how we were doing the mapping, so we could track the expenditure. Like I said, we didn't have that granularity of information. So think about what would be useful information to your decision makers and therefore set it up appropriately. Second, make it as easy as possible. If it's easy, it's likely to be done, and it's likely to be done well. You don't want data rubbish in, rubbish out, I think. Can't remember who said that this morning. So make it as easy as possible to give complete the returns. So training, absolutely. Guidance. Invariably, when I was developing the packs, that was before the financial statements were coming up. So there were questions that kept coming up. So I used to have frequently asked questions, used to put it onto the website. If I've been asking the same question, made sure I had a dedicated email account to get the questions in. I don't think people realized it was only me answering those questions, but anyway. So, and that's really important for the engage and communicate process. It's that they feel if you make it as easy as possible, they're more likely to complete. And the intergroup transactions, yeah, the transfers between central government and local government, or transfer between local or central government on state-owned enterprises, or local government within their own areas, how much, and their own consolidation issues, where they're partnering with private sector, etc. We had terrible problems with particularly grants with restrictions and conditions. Central government might give a grant for something that's not used for another 3 years. But if it's got condition and it's got a restriction, how do you marry the two up? So what we used to do is put in match relationships. You're more just to say, have you thought about, and what about this? If this is a receivable, it's likely to be a payable. So we had typical, make it, like I said, make it as easy as possible. The person completing the information might not be an accountant, might not even care about finance. But we need them to get it right so that we have good information at the center. And make information, as much information as you can available. Publish it. Show, like the website, make it available so that they can see each of the drop-down menus, what's available, what central government's paid to each of the local authorities, what the local authorities are saying with each other as well. Okay, so those are my practical tips. It's just focus on those. A quick thank you, but those are my resources. There's links to that, but if there's anything else that you can always find me. After 3.5 years of living and breathing this, I'm sure I can bore you a bit more on consolidation. Thank you.
Thank you very much, Matt. It was great to hear that we all face challenges. And this morning we had a lot of discussions about Estonia. So now we want to know a little more on that. So I invite Guido, please. Try to connect them. Okay. I thought that again, this is should be somewhat more practical session, and then just mind you, I want to say somebody must always go the first. There has to be someone jump in, and that is precisely, I know the feeling. What you need to do, but to help, I thought that in the second session I would consolidate, concentrate on some practical how-to, especially in the state-owned enterprises. What do we do, and what should we take into consideration? So first, don't be afraid of these different standards. That is, in the end of the day, especially differences between IFRS and IPSAS, they are insignificant, or no, they gave they gave you the roughly right answer in a very proximate situations. So the end result should be basically the same. And of course, the less standards, different variation we have in standards, the better. Like they are like when we measure temperature, then there are Celsius degrees, and Americans do it in Fahrenheit. Then we can translate one to the other. If we go to US, we need to calculate how to get the Celsius degrees and know how warm or cold it is outside. Basically, that is the same transactions we do from one standard to the other.
And again, go for simplicity, practical and conservativity. Usually that means prefer accounting methods that are allowed by both standards. For example, in public sector, we have no fair value almost, some financial instruments only, some sophisticated hedge funds and biological assets, which I think are used, but property, plant, equipment is historic cost, although it would be allowed in some way to have more fair value somewhere. And in the end of the day, what you do in this reporting package that Thomas introduced earlier, and basically you translate from one chart of accounts to the other chart of accounts. And this should be done in the bottom level, on the account level. So when you have a company, state-owned enterprise that does IFRS, we have these, they are in even stock exchange, they will continue keeping their accounts as they are. They are not directly kind of wired into the state system, no. But they they translate their income and balance sheet statements into the reporting package. And from there onwards, the consolidation system takes over. And also finally, when you move, so if you change something in one chart of accounts, then at least in the reconciliation needs to be made with the other, even if the other says the same. But in the account level, you need to know where this account here goes in this account system there. That's basically, and on the bottom level, that works. And one maybe practical lesson from my past is that that was a real aha moment, and I started to consolidate a large group that basically it's worth to keep also the adjustment, consolidation-related corrections and adjustment that you make in this middle column on the double entry basis, so that they are debit and credit also there. That helps you a lot to keep it in balance sheet, keep the bookkeeping in balance. So again, I will show you here. Take this as a picture. This is an example from that I took. It is a Tallinn airport commercial entity in Estonia that operates Tallinn Airport. Their profit and loss statements from two sources. First, on the left is the state consolidation system, and in the right is their annual report of 2024 from their annual report that I see in commercial register in Estonia. So I just took the screenshots from both of them. And as you know, although we don't recognize the language, then we do recognize the numbers. And I believe we do also recognize the format. That when it's a profit and loss statement, then we know it is profit and loss statement. So profit and loss statement. So the first and bottom lines should match. And as I made the colors match here, basically you see a slight difference in what is in the violet. One is in the annual report is in thousands of euros. That means the turnover basically was 64 million and 151,000. And then when you look at right, it is 64 and 162. But this is not the net sales. This is again this revenues from economic activities as it is counted in the public sector format. But the essence, green basically is the operating profit, which again is the operating surplus in public sector. And finally, the light green, which is 465,000. And in the state, we have the based not in rounded numbers, but by cents up to the top preciseness. And again, basically the differences are minor, but the representation, the picture looks a little bit different. And that, I believe, is also from the practical sense, even it's not so much the difference between standards. The two standards essentially gave the same result here. And this is from real life example last year. But maybe the culture or etiquette. If you go to the meeting room in public sector and start as an accounting person as I am, start talking about profit, and you said, no, we don't have profit. But still they just in the public sector, you have to call the difference between revenue and cost, then surplus. But then you go to the private sector, then you talk about profit. Economic substance is the same. There is no difference, but it's a kind of like how you perform or how you behave or what is polite in one context and what is polite in the other. And from there, a lot of misunderstanding often arises. But the standards, IPSAS is based on IFRS. It is more discrepancies when you have in business, if you have a parent company in US and a subsidiary in Europe, then translate one to the other is much more work. So this is actually not so big an exercise. It's not something that I think we should be afraid of. That's more often exaggerated. And but another thing that I thought that I will show you here that is maybe practical, I will go back live now again into the system, is that I will take the same example of the airport. Sorry, misspelled. That is the airport entity here. I will take the 9 months and 2025, and we have 6 basically standard reports that are published made for the public here for every entity. Everybody can look. You can't look military entities here. That is the only or power police force, for example, that are not publicized. But for them, you have what I showed you in the morning. Income statement common, but there is also income statement in detail, which gives you, and here I will make now the push the translate button, then becomes more closable. But that shows you the things that I wanted. Is the detailed account-based profit and loss statement in the IPSAS or IPSAS Estonian account state accounting format, not in the IFRS or the business reporting format, but result picture is the same little bit different representation of the same thing, actually. And here, these are the, because it is long, that shows you the chart of accounts actually on the left column, which is exactly how you build the system. And in our chart of accounts, assets usually start with 1, liabilities start with 2, income accounts start with 3, etc. And in the end of the day, we have 6-digit chart of accounts in this consolidating package that every entity report puts into the system from their own accounts. Inside, they will probably lose more because they on the entity level they want to have managerial accounts also, how different departments are performing or different units in the different cities, or for example road departments and in one city compared to road department in the intercity roads or whatever. However, their management routines are built there. But on the state level, in the East, we take 6 level accounts, and it shows you also one is included in the other, so how the sums are aggregated from the system. So it's basically the backbone of the system is chart of accounts for the full balance assets, liabilities, income, cost. up to the end. This is, I would say, like a similar to any normal business entity in the private world. And what you do in consolidation is basically before you send the reporting package in, you translate from your own system into the other. And the less translation we have to do, the better, of course, because it's enough if you have to translate from Fahrenheit to Celsius and vice versa. But if you would have the third standard or fourth standard, then you would have to do it more. And that's not very practical issue to do. I would probably leave more now for questions. And that is basically I would like my intention was to show you a view from the kitchen, how it is inside, how it does look from inside, and hopefully that was of help. But looking forward for questions now, I believe.
Thank you very much. We do an applause also. So colleagues, now it's your time to speak directly with the colleagues that have already implemented this and know the ins and outs, what worked, what didn't. We covered a lot of those practical examples during the presentations, but I'm sure that the floor has questions, so I will open for questions. Who wants to go first? We have one question in the translation enabled, please.
Thank you for your great presentation. I have a question. The SOEs can be established by central governments or by local governments. Is there a difference when you do consolidation? If SOE submits, do SOEs submit a reporting straight to the central governments, and are they consolidated in the centralized level, or do they file reporting to local governments and then the consolidation is done through the local government?
That's a good question. Who wants to take it?
Basically, no, I would say. Simply when it's reporting to municipality, it's owned by municipality. For example, in Estonia, it's by City of Tallinn. We have Tallinn Water, for example. Then they are still consolidated, but firstly to Tallinn balance sheet and then to the whole of governments. But they are listed in they have their own code in the chart of accounts as a counterpart. So to eliminate internal transactions on the respective level. But basically the format is the same. The report package is the same, no difference. And system where you put it in is the same.
Yeah, so I think the way I would think about it is as Guido said, is a series of consolidations. So you're applying the test of control to the municipality or to the subnational government, and if they've got state-owned enterprises or commercial activities being done through a subsidiary, you'd consider control at that level, and then there would be a further consideration at the national level. So you're kind of working your way up a ladder almost in terms of thinking about consolidation. So it's not a single process. In lots of cases, it will be layers of process happening and considerations happening at each of those levels.
Sorry. And thank you. Given that UK doesn't strictly follow control, that is set, what is included in the accounting boundary is usually determined, well, it's determined under the Government Resources and Accounts Act, but it's determined by Treasury as to what is included, and that's done in consultation with the ONS. So if that state-owned enterprise is with local government or central government, the rule for us is has it been nominated as being deemed to be part of the public sector, then it's consolidated, given its own counterparty identifier, the CPID, and then that's how you do the eliminations. There is a list on the slide deck. There is a list of the various entities that are included, but importantly also gives you a list of the entities that are not included. So you've got complete transparency. Say, well, why haven't you included X or Y? And reasons for differences. We were qualified, sorry, I'm just going off a slight tangent. We were qualified for not following the consolidation boundary, we, UK government, but for following ONS, but the Office for National Statistics that prepare the GFSM, etc., they are consolidating English further education institutions, but that's not included in UK whole of government accounts. So you've got a difference the other way, and that's one of the reasons for the qualifications. We know there's a data gap. We make that clear. There is a data gap. Yes, the state-owned auditors have a view about that. They're not happy about it, but we are being transparent. So anyway, I digress a little bit from the question.
No, thank you very much. But this is exactly what we are looking for, the practical example, the three different views. So please, next question. Montenegro. We have where? Armenia.
Thank you.
And then we go to Armenia.
I would mention previously in previous presentations, and also you mentioned sustainability reporting. And when we are speaking about consolidating public sector financial statements, I have a question for Mrs. Kalar. Do you see challenges in sustainability reporting when we are speaking about boundaries and when we're speaking about scope of financial reports, and also when we're speaking about principles, controlling principles? Do you see challenges in sustainability reporting, considering that your country actually has implemented sustainability reporting? Thank you.
Thank you. That's an excellent question. I remember you from last time when we were talking about sustainability. Okay, Ross isn't here, so I can say. This is one of the problems I had with the sustainability standard as it was proposed. It was looking at the entity in itself, and it was looking at, what does it mean as a whole? And I thought, now, for commercial reasons, private sector have been following different standards, GRI or whatever, for sustainability reporting for a while. But for us within government, not really. So to implement it in 1 year, I thought that was a no-no. But more than that, that was looking at own operations, but looking at how government set the policy. For example, how many electric vehicles, that no more petrol or diesel vehicles can be sold after 2030, that kind of thing. Or everything has to be net zero by 20, whatever. The date keeps moving. That is really hard. As we know, I'm very open in sharing everything that we've done right, but we've lots of done things that we've not, lessons learned, shall we say. Coming back to your question, is it going to be difficult? Absolutely. How do you define that? And the boundary issue again, to think about. And I have wrestled with this thought in my mind. Is it for accountants to do sustainability reporting? That's a more fundamental question. Or should it be, so you have the Public Accounts Committee, we also have an environmental committee. Should the environmental committee be asking for that information? But as we know all the finances, everything links back to money, finance, and we know that, therefore it's a good place for us as accountants, but do we have the skills to be able to do everything in sustainability reporting? I don't yet. There's lots of professional development, CPD for me. Will we have all of that information to be able? I think that the boundaries are going to be quite even more loose. How does it impact private sector, but how do we record the same for public sector entities? I think it's going to be really hard. I don't think this is, well, from experience, I can't see that this is going to be easy to do. I'll pass it to my colleagues if you want to add in.
So in the UK, the approach to sustainability reporting has deliberately been staggered and phased. So when Treasury started to think about what it wanted central government bodies to do, it didn't try to do it. There was no attempt to do it all at once. Interestingly, so I sit on FRAB, which is the Financial Reporting Advisory Board to Treasury, and we're having that debate about, so should that board own the sustainability reporting, and if it does, what does the makeup of that board need to be in terms of expertise? So I think the way that UK central government have gone about it is very sensible. I think your question is absolutely right. You're asking, when you start to think about scope 1, scope 2, scope 3, it's a completely different set of considerations to the one we apply when we're thinking about control and group boundaries and those sorts of things. And so I think there is a challenge then that you could be presenting. And at the moment, I should also say, there's been no attempt to consolidate sustainability reporting in the UK. One of the things that I think Treasury has done very well is that they've allowed some things to be at the discretion of individual entities, but where they have felt that it's appropriate to set standard sets of assumptions, particularly when you're looking at some of the longer term modelling that you need to do under the TCFD requirements, they've actually provided that to practitioners. So I think there's lots of good learning in that, but it has been very, very staggered. But I do think there is a point there, isn't there, where if we get to a point where we're publishing consolidated financial information against one set of group boundaries and sustainability information using scope 1, 2, and 3, those are, we're going to have to explain to users how those two things are potentially very, very different, which is why I think, and this is a personal view rather than a CIPFA one, I do think sustainability reporting in the long run probably will sit alongside, but outside of general purpose financial reports. That's not to say we won't have bits of sustainability in those, in the financial statements themselves, but I do think eventually we'll land on a more separate standalone product because it would just become too confusing. And if we say financial statements are already too long, they're going to be even longer and impenetrable. So, but it is a really good point, having to think differently depending on which of those things you're applying.
I have a question. Today, during the day, it was mentioned that there is little difference between IPSAS and IFRS. I'd like to draw your attention. One of the conceptual differences is the definition of the assets. Private sector, these are resources so that you can derive economic benefits from them. And in IPSAS, it also includes service potential. When we do consolidation, do we look at the fact that the SOEs, which are doing business, can have assets which have service potential, but by definition, they should not be recognized in financial reporting. What do we do in this case? Thank you.
Question understood, but again, in the public sector, I would say the definition is wider in scope, and that it should be, because schools and hospitals provide more than economic benefit, but they also included this economic benefit is embedded in this, let's say, in social benefit, if you want to define. And in business entities, basically, you shouldn't have this, if this is the limitation. But in the practice, I haven't met the discrepancy. The schools are, we have hospitals that are formed as stock joint companies legally, and they are still, they treat the same way. They don't write off the hospital because of that, or vice versa. There is really no difference. Property, plant and equipment, and also we use as simple, straightforward methods of measuring that as possible. For example, historic cost in the property, plant and equipment only. I don't know if that answers, but in practice, no, I don't see the difference.
Thank you, Guido. We have time.
I like to give one example to make it more clear. The SOE has the garden, and in the garden there are benches and people sitting on the benches. This is not the government's entity, this is SOE. But as this doesn't deliver economic benefits, the SOE should not recognize this asset, and if I consolidate at the government level and WGA level as the public entity, then they should recognize this asset. For the business, this is not recognized, and for the public sector, it should be recognized because it complies with the definition of the asset in the public sector. Just for example, the state-owned enterprise, the SOE, has the garden. Just for example, it has the garden with benches, and people can just sit on those benches just to have rest. This is not a business. This doesn't bring economic benefits. It doesn't bring any money, but it has useful potential. It has service value because service potential because people use the benches for rest. In terms of IFRS, it is not recognized as asset, and in terms of IPSAS, this should be recognized as asset. How do we consolidate in this case? What do we do? Do we do adjustments? Do we recognize this asset on the balance sheet of the SOE?
We don't do difference exceptions. I've seen a lot of corporate in private sector, a lot of corporate headquarters, if you want, real estate that is not directly related. It's not written off from there. From practice, I don't know that. I don't see the difference. I have these Tallinn Airport, for example, they have a lot of land. They are not used directly for landing. The land is still there as a property, plant, and equipment when they have acquired it. It's not written off.
Thank you for your question. Let me clarify what I meant about not so many differences. Before, there was a huge difference between IFRS and IPSAS, and over the last few years, you can see how much
alignment.
There's been huge alignment between them as IPSAS have become more mature, and then they can focus on public sector specific issues. But you're absolutely right. Some differences remain, and some differences have arisen now. We're looking at this with IPSAS 46 with measurement, particularly for schools. How do you measure? And you've got your current operational use as well. In reality, has that meant a lot of change? Who knows? But there could potentially be changes. So one of the things I do for one of my clients, they've got lots of state-owned enterprises all following IFRS, and then central government all following IPSAS. So when they're doing the entire public sector set of financial statements, I mentioned a bridging table. It's almost having that reconciliation between, okay, you've got this information for IFRS, what do we need? Now, in the scenario that you've given, I'd question, is that material? How often does that happen? And then start thinking, because otherwise we'd be worrying there'll be lots of such scenarios. But if there's a lot of that, then usually it's for the Ministry of Finance to then dictate, well, what information do they need? And if they need that type of information, how are they going to get it so it's consistent for the financial statement? So there is extra work. I'm not lying. I'm not going to hide that fact, but there's that bridging table to make sure that the financial statements will get through audit. And they usually bring in the state audit as well to make sure that there's alignment. Hopefully that answers your question.
Thank you very much, Manj. No, just so you know, most of our speakers will remain the next few days. So please, you can contact them and address any other question.
Nisret, please join us. Nisret Kosa is Acting Director General for Treasury of Kosovo, Ministry of Finance. Minas Trubljanin, please join us. Minas Director General, Director for Central Harmonization Development. Karen Alaverdian, Head of Accounting Methodology Department, Ministry of Finance of Armenia, and Dmitry Garfunkel. So, yes, Nisrat, please. So this session is about, we're going to talk about the country level programs. As we discussed, this program is PULSAR 2 is about, we are having country level program. You received those two documents, 2 pages, where one was talking about subnational government, challenges, solutions, and consolidation, 2 documents. Hope you have read through those. So now we are going to talk about, to present those countries where we already agreed country level activities. This is needed for transparency, but also to provoke some thinking for the countries which still think to apply, and they consider which areas they would like to apply for PULSAR country level support. So please just have a look, because on day number 3, we're going to have next step discussion around our tables, during which each country is going to discuss and brainstorm what type of support on country level you expect. So this session will give you some hints what our potential other countries are working on. Thank you. Nisrat, the floor is yours.
Thanks.
Good morning to all of you. I'm going to present the ongoing PULSE project. But initially, as a way of introduction, I'd like to refer to some objectives recently set by our government in relation to budgeting, green budgeting rather. Kosovo, like other countries, is increasingly focusing on green budgeting. So it has undertaken to also include green budgeting codes and classifications. This is explained by the fact that all reporting and accounting aspects should be fully in line with the relevant concepts. Secondly, it is important for the asset management goal to be referred to be mentioned. This requires us to look at the various concepts of asset management, as well as the integration of financial systems in public financial management. The transparency portal should also be mentioned. But one important development is the PULSE assessment, expected to start soon. Currently, the Minister of Finance of Kosovo is cooperating with the PULSAR program to initially conduct a PULSE assessment, to be followed soon by an enhancement of accounting systems. It should be noted something else, but before I go there, I would like to take this opportunity to thank the donors and the PULSAR program for having selected us to conduct this assessment, to assist us with this assessment, and with the development of the financial accounting framework in Kosovo. The Minister of Finance Treasury has developed a concept note for the PULSE assessment. We are going to submit this to the WorldBank representatives, more specifically to the PULSAR program. The government of Kosovo applies the IPSAS, or rather it has adopted IPSAS since 2003. It has advanced with their implementation. However, we apply cash accounting. Our goal is to further advance, like other countries, and to move towards accrual accounting. In the future, I think, is going to be our special focus. One advantage in this case is Kosovo has a harmonized chart of accounts from budgeting to planning. So we have this single chart of account, which is done from budgeting, budget planning to the execution, to budget execution, or rather to financial reporting. This enables us to prepare consolidated reports for the general government. However, such reports do not include public corporations, that is state-owned enterprises. We intend to do so, that is to include those public corporations in the future. We will advance, of course, we will do so in the future. But to get back to the PULSE assessment, the goal of the PULSE assessment is to support the government of Kosovo with advancing the accounting system to assess public finance management and to also assess the matching. The specific goals of the PULSE assessment is to identify any gaps in the implementation of IPSAS standards and the challenges of institutional harmonization, and to prepare a comprehensive report with findings and recommendations based on the assessment. Key activities for the assessment include the gathering of data, collection of data from institutions on the current accounting practices, and an assessment of financial reporting 2024-2025 with a special focus on this period of time. Comparison of national practices with international requirements, specifically IPSAS requirements, and a preparation of the final report with findings, challenges, and recommendations stemming from that assessment. The implementation of the first phase, that is the transition, and the annual report. Based on this, we intend, or the plan is, for a period, a transition period, for moving towards the financial reporting in line with the public finance management strategy. A new strategy is intended to be adopted for 2026-2031. That new strategy will also include goals and targets for improving financial and accounting reporting in Kosovo, as well as the action plan for implementing those goals, which have been found to as important to improve these systems based on the PULSE assessment. The expected outcomes from the PULSE assessment include the following: harmonization or alignment with key IPSAS standards, with enhanced accounting practices in line with IPSAS standards, improved professional skills and capacities with support from the PULSAR program. We think, we hope that we are going to have trainings to enhance our officers' skills in public institutions so that in the future we can have a professional team nationally in order to implement the requirements deriving from PFM reforms. Another expected outcome is the digitalization and modernization of the financial reporting system. Public institutions in Kosovo, that is general government, as I said, applies IPSAS, so cash-based IPSAS, while SOEs apply IFRSs. As a result, both the Ministry of Finance and the government receive reports from the Treasury and from SOEs through a special body, which is the Council for Financial Reporting, which licenses and monitors public corporations, SOEs, or rather receives reports, financial reports from them on behalf of the Ministry of Finance. So it is not impossible that in the near future, given that we have the information and given that we have the data, the method of reporting to be aligned through the implementation of systems and interinstitutional cooperation, which will ultimately result in a consolidated report for the country as a whole. The increased transparency and public accountability is another expected outcome that will be facilitated by having more clear financial statements. Improved PFM is also another expected outcome. PULSAR will assist us to strengthen the accounting and reporting pillar in the public sector through their advice and their assistance, which will be ongoing in the future as well. I believe that we have learned from various experiences in the past that has enabled us to advance our financial systems. We've also learned from our peers from various countries represented here. We've also learned from PULSAR experts, so experts that PULSAR has invited to speak in such conferences. Financial reporting in Kosovo includes financial statements, of course, but also reports that have information and data that will help us transition towards accrual-based accounting. For instance, recently, we have reported on assets, on non-financial assets. We have reported payables, on receivables, on contingent liabilities, and such information is published, is already there. However, such information is not integrated, is not consolidated into key financial statements. When the infrastructure is in place, it will be easier for us in the future to move towards in our transition to accrual-based accounting. Therefore, as I said, quite soon we expect to begin with a pulse assessment. We will see what the recommendations will be. We will see what our weaknesses are. That will help us develop an action plan to further continue our efforts in advancing financial accounting reporting in Kosovo. Thank you for your attention.
Thanks, Nisret. Many thanks for update. So as Kosovo presented, PULSAR program supports with the PULS assessment as the initial step, and then PULS assessment will inform next follow-up activities by Kosovo. And this will also, you have raised also the need for sustainability reporting support, but it was agreed that we will come back to this topic after IPSAS issues the SRS, Sustainable Reporting Standards, and we'll discuss it further. Probably as we have a separate country discussion, if you have any question to Nisret, just to raise your hands. Okay, then thank you very much. Then we can move to Minas, please. There was a question? No. No. Okay.
Thank you, Arman, and thank you to the World Bank for inviting me to present our achievements, ongoing reforms in Montenegro, because we have a lot of reforms which we are conducting, and also to tackle some planned reforms in the upcoming period. So, as I am directly responsible for oversight of SOE sector in Montenegro, my presentation, as you can see from the title, more focus on SOE sector, and during the presentation I will tell you about the technical assistance which we received from different parties, from different partners and international institutions, and where we are right now. So, as we heard this morning, consolidation is, let's say, the last phase in conducting reforms in one country. So at the beginning, I would say that in Montenegro, in case of Montenegro, we are not performing this consolidation as it is actually planned and predicted. And as you can see from my presentation, I will talk much more about aggregation of financial statements from SOE sector. As I said, in Montenegro, we are conducting more and more reforms in many fields, in many areas. Why? Because we want to be prepared for, as I said, last step consolidation in terms of ensuring that our data, financial data from statements is complete, accurate, and reliable. So you will see which kind of reforms we are performing, which are ongoing, and what is actually our intention at the end. So when it comes to establishing a system of monitoring of fiscal risks in Montenegro, we have this relatively new division for fiscal risk, division for oversight of fiscal risk and monitoring of fiscal risk of SOEs, which is established within the Ministry of Finance. And since its establishment, we received significant support from the side of International Monetary Fund. What was this support? It was in a sense that we have been provided with methodology, clear methodology for identifying, assessing, and monitoring fiscal risk. And also we have been provided with health check tool, SOE health check tool, through which we are conducting those fiscal risks. At the end, we had a lot of, let's say, trainings and educational events with IMF experts. And at the end, what is the result of all of those activities is that we are conducting on a regular basis financial analysis of SOEs. We are putting them in one of 5 categories, which are actually prescribed by IMF methodology. And at the end, we are preparing one aggregate report on financial performance of SOEs in Montenegro. As you can see, categorization of SOEs according to this methodology is from rate 1 to rate 5, out of which rate 1 is the lowest risk and 8.5 is the highest risk. Today, we are performing, as I said, on a regular basis, on a daily basis, some kind of those analyses for the purpose of issuing maybe some opinions for borrowings or something like that for SOEs. In terms of enhancing, let's say, transparency of SOEs, We conducted some activities in regard of establishing a register of SOEs in Montenegro. So the first stage, we established a public register of SOEs at the central level, and the second stage was establishing a register of municipality-owned enterprises. Both of those registers are published at the official website of Ministry of Finance. And as I said, we wanted this way to, let's say, enhance transparency of financial performance of SOEs. So within those registers, it can be found also those financial ratios which we are assessing, and by which we are putting each SOE in one of those categories of risks. So what is also intention this way, that we want to enhance also managerial accountability in SOEs and thereby contributing to a more functional system of planning, monitoring, reporting, and oversight of those enterprises. As I said, we want to have at the end as much as it is possible complete, accurate, and reliable information from financial statements. In this regard, I want to mention that we received huge support from the WorldBank team in the field of accounting, auditing, and financial reporting. What was this support about? At the first stage, we received support in, let's say, establishing effective system of public audit oversight in Montenegro. At the second stage, what we received is assessment of our system of accounting and auditing in Montenegro, and developing and providing a risk report, so report on observance of standards and codes in auditing and accounting. Why? Because this was a very important input for us in amending and changing our regulatory framework. According to those findings and recommendations which we received from the WorldBank's team, actually this was Center for Financial and Sustainability Reporting Reform, we amended our law on accounting and law on auditing. Both of those laws are at the same time applying to the SOE sector, because SOE sector is operating and doing their businesses according to the company law and the law on accounting, law on auditing, etc. So according to the law on accounting, all SOEs are obliged to organize their accounting according to IFRS, and by precisely stipulating the accountability of each individual in the process of, for example, from the first step, issuing some accounting documentation, then drawing up the financial statements and approving financial statements. So we prescribed a clear responsibility of each of those people. So in this way, we wanted, to also enhance awareness of all of those individuals in the whole system about the importance of providing accurate and reliable financial data in financial statements. So all of them are accountable for the part of job which they are conducting. When it comes to new law on auditing, we also enhanced some provisions which are related to oversight of audit firms and statutory auditors. Why? Because we want to also enhance this part that auditors, because auditors are actually auditing financial statements of SOEs, the rest of enterprises in Montenegro, and if they are doing their job in the right way, according to the standards. We are sure that the statements by themselves are of a much more better quality. Also, when it comes to this regulatory framework, I want to mention something which is not here at this slide, is that we are we adopted actually a new law on governance, internal control, and internal auditing in public sector. Why this is important from this perspective of SOE sector? Because in this law we clearly prescribed obligations and responsibilities of governing bodies in SOEs in relation to internal audit function. I would like to also emphasize that our PEMPAL community of internal audit practice is also something which is very useful and very, because we receive from this practice community a lot of inputs, very useful inputs and insights in other countries, according to which we can compare our legal framework and conduct what is needed. In terms of SOE sector and this oversight, we adopted analysis of institutional and regulatory framework, and according to conclusions of those analyses, we drafted new law on governance of SOEs and new, let's say, state ownership policy. Also, we drafted strategy on corporate governance of SOEs. In these terms, I just want to mention that BEST project, which is conducted by the WorldBank in Montenegro, is something which is of utmost importance for us in drafting of those documents and conducting all activities which are beyond those, let's say, visible results at this stage, because many of activities have been conducted, many of activities are planned in the upcoming period. So we believe that Ministry of Finance as a main driver of this reform in Montenegro, in cooperation with the WorldBank team, will finalize this process, and we will have a successful reform in Montenegro. When it comes to aggregation of information from SOEs, when it comes to aggregation of financial statements, as I said, we at the end provided aggregate analysis, actually aggregate report of the financial performance of state-owned enterprises for 2023 with fiscal risk statement. And this was the first time that such kind of document was prepared and adopted in Montenegro and published at the same time. And this is, I think, one of crucial steps in better oversight of SOE sector and strengthening the corporate governance in general. We prepared according to this aggregate report for 2024 also, and from this slide you can see some main, let's say, aspects of this aggregate report, because we gathered the information for the last 5 or 6 years for each SOE and made some kind of comparison and presented actually what was the percentage of annual expenses or annual revenues of SOE sector in comparison with GDP in Montenegro. Also, those are some also main points from this summarized, let's say, main points from this report. As I said, we are assessing and identifying and monitoring, let's say, ratios of liquidity, profitability, and solvency, and we are rating each SOE in some of those categories of risks. You can see what were the results of this analysis for the last 4-5 years. It is from insert from report for 2023. So we have many, let's say, SOEs in 3 and 4 category. How the Ministry of Finance mitigates fiscal risk in the SOEs? As I said, we are at the stage of adopting new law, new legal framework, which will ensure us, better oversight and better governance of SOE sector in Montenegro. We are preparing also a strategy on corporate governance of SOEs, and those are, let's say, preconditions for the upcoming, activities and upcoming actions in this regard. So we will continue to issue those aggregate reports during the years, and at the end, I believe that we will have accurate data for consolidation of the whole public sector. What are our intention in upcoming period is that according to law on accounting in public sector, we are moving, and this is also one significant reform which we are conducting in Montenegro. We are moving from cash, actually modified approach to accrual accounting. And in this regard, colleagues from our treasury are conducting a certification process of public accountants for many years. I think for 2016 they started in order to invest in our capacities before, skipping in the final stage of this reform to be prepared for everything which is in front of us. What is also important from the perspective of Montenegro is that we will need support in asset management in upcoming period. So this is something which we need to deal with much more stronger, let's say, and in a much more details. And I guess that in this process of consolidation of local self-governments and SOEs in the whole, let's say, public sector accounts, we will need also some support, but it can be discussed, as Arman said, at the last, third day, this event. So in general, that's it. I will not take more time. If you have any questions, do not hesitate to ask.
Thank you, Minas. Questions, friends? On the PULSAR support, you will come back on day number 3, right? PULSAR program support. Aaron, please. Day number 3, we have reserved this a session where, as we discussed, you will have around your table discussion of your country priorities. And at the end, we will expect you to come back with your priority lists. So what type of support you would expect from PULSAR program, country level program. Yes, please.
Thank you, Arman. Thanks for this opportunity to share the information about the public sector accounting reform in Armenia. I will briefly talk about the current stage of our reform to share with you the information where we are right now, what we have done up to now, and what are our future steps. And also I will talk about pulse assessment that was conducted in Armenia in 2023. Regarding the current stage of our reform, we conditionally divided the whole process of our reform in 3 main stages. So the first stage was about the formulation of legal framework in order to maintain accounting in public sector. The second phase could be named as implementation phase. So how we implement that legal framework, and also the final stage, which is also the main goal of our reform, is about the consolidation, because the main goal of our reform is to have consolidated financial statements on the level of government from some point of time, and we already started this process. What we have done in terms of formulating legal framework in Armenia, the process was started in 2014 when the law on public sector accounting was adopted, and this law sets the main requirements, main obligations for the public sector organizations in order to maintain accounting in accordance with the accrual basis requirements. For that purpose, we developed our national accounting framework, which is based on IPSASB, and we call it APSAS, Armenian Public Sector Accounting Standard. It was developed in 2014, taking into account the standards that were in force at that time, but taking into account that there were significant changes in IPSASB up to now, we are going to make a revision of our standard as soon as we have some results on consolidation, so after the completion of the consolidation phase. Another important legal act is chart of account. I can say that this is, let's say, multidimensional chart of account, because it allows to have not only information for the financial reporting purposes, but also for budgetary purposes, and also it integrated also the information for statistical purposes, but we are going also to make some additional revision in chart of account in order to have information for the managerial purposes as well. Forms of financial statements were developed from our side for the separate public sector organizations, and our next step is to develop financial statement forms for the consolidation purposes, to have financial statements on the consolidation, different level of consolidation. Another important legal act is our outsourcing system, because according to the law, according to the legislation, public sector organization can outsource the accounting function to the private sector. So for this purpose, we developed some mechanism of accountability in order to have necessary information about these entities. And also about qualification system, that we can say that is main result of PULSAR 1 program, because we developed our qualification system based on knowledge, based on information we get from PULSAR 1, and we introduced our qualification system, public sector accounting qualification system in Armenia, and right now we have more than 500 qualified accountants who have necessary qualification in order to work in public sector. This slide shows the results of implementation phase. As you can see, the quality in public administration bodies and state non-commercial organization is much more higher than in communities. We can see that about 80% of public administration bodies and state non-commercial organization prepare their financial statements in accordance with our standard, in accordance with IPSASB. But when we are comparing this information with communities, we see that about 60% of these entities, communities, and community non-commercial organizations don't prepare or don't use properly accounting frameworks. So I'm going to speak about this problem in upcoming slides. What we have done on the consolidation purposes, our legislation law says that we should prepare financial statements on the level of government starting from 2024. And starting from this year, we prepared, let's say, trial financial statements on the government level, on the state level, including 360 public sector entities, information from these entities. And also we have included the information about the very important items like public debt, tax revenues, and information on state property. In the upcoming year, we are going to increase the coverage of these entities and also items that should be included in the consolidated financial statements. Regarding PULSE assessment, as I mentioned, we conducted PULSE assessment in 2023, and Armenia was one of the piloting countries together with Ukraine. And I can say that the huge work was done by our team, and we have very good results. I'm not going to talk about the purpose of PULSE assessment because we already discussed this. We included 8 different entities in our scope of assessment, which are taking into account their activities. And the assessment covered 6 components: the legislative regulation of public sector accounting, the information on financial, non-financial assets and liabilities, on expenses and income, and also the report was also assessed the preparation system of financial statements and also dynamics of public sector accounting reform. Here are main results and also recommendations. The overall score was B, which is evidence of high degree of compliance. Of course, there are some gaps with IPSAS requirements. As I mentioned, our standards was developed in 2014, and of course, there are inconsistencies between IPSASs, but as I mentioned, we are going to do revision after the phase of consolidation. By the way, the report is published on the Minister of Finance website as well as on the CFRR website. About future steps, what we are going to do. Here are our main phases of reforms: legal framework, implementation, and consolidation. And we have grouped the main challenges in two main groups. The first one is about the challenges regarding digitalization. And the other big problem is connected with the capacity of our professionals, capacity of our public sector accountants. What are our intentions regarding the digitalization? We are now in the process of developing IT integrated tool in the Republic of Armenia. We call it GFMIS, Government Financial Management Integrated System. And now we are in the final stage of tendering. And we assume that GFMIS will consist of different public financial management components. One of important or core modules would be public sector accounting module. And public sector accounting module should let us to maintain accounting on the centralized way. The other important expectation from the accounting module is the automatic preparation of different financial statements, different set of financial information apart from financial statements, also budget execution and statistical reports in accordance with GFSM 2014. The intergroup transaction should be automatically eliminated after the introduction of GFMIS, or a module of public sector accounting, and also our final goal or our final expectation should be implemented via GFMIS. It is automatically preparation of the consolidated financial statements on the different levels. We assume that and expect that public sector accounting module should include different submodules. These are just classic submodules which are helping to maintain accounting properly. It should include, for example, the submodule on tangible assets or purchases or human resources, etc. So classic submodules which are helping to have proper information on the for the accounting purposes. Regarding second group of challenges, capacity building, of course, we have taken some necessary steps in order to enhance the capacity of our colleagues and also to enhance the quality of financial information. For example, we are doing monitoring of financial statements in public sector. We organize field visits to the different public sector organization. Based on our monitoring results, we prepare so-called professional handbook on the mistakes which were done by different entities, and we share this information with our colleagues to avoid further mistakes. Another important way to enhance the quality was, as I mentioned, our qualification system, and upcoming our expectations, which are also which we have discussed already with our colleagues, and here are the expectation from PULSAR 2. It is the training. As I shown on my previous slides, the quality of financial information in communities is quite low, so it is necessary to have and crucial is to have a training for our municipal accountants in order to enhance the quality of information in that field. And also we need different knowledge products which will allow us to also to enhance the quality of financial information. This could be, for example, guidelines on accounting of heritage assets, on infrastructure accounting, or guideline on public debt accounting. And of course, one of our important expectation, which was mentioned from our side, is some regulation or guideline in order to include SOE counts in government financial statements, which is our main topic for our event. Couple of words about the sustainability reporting. Now we are in the process of developing country action plan and policy note for the introduction of sustainability reporting system in private sector. I think that after having this work and after the results in private sector, we will think about the introduction of sustainability reporting system in our public sector. But before that, we think that analysis or study should be done in order to assess the current situation and also what should be done in order to have proper results for this matter as well. That is from my side. Thank you very much.
Thank you, Karan. Any questions? On the PULSAR side, just to clarify, we're supporting on subnational government report, this training and the guidance, and also on revenue recognition on the PULSAR. It's country level activity supported. Thank you very much. Now let's move to Dmitry. Dmitry, can you update us what's happening with our PULS tool? As the geography is becoming broader and we have completed already 5 PULS assessment and we're having even more demand.
Sure, man. Thank you and good to be here. Good afternoon, everyone. So I will be very brief. I know I'm the last obstacle between you and the dinner on the free evening. So I prepared a couple of slides on the latest 2 assessments we had and also some news in terms of the update and upgrade of the PULS system, PULS assessment tool, and the next steps. The last 2 assessments were in Georgia, and Lela last year already shared some preliminary results, but now the assessment is finalized and published. So this is kind of final results. Also, both Georgia and Tajikistan, they applied the slightly revised methodology. In 2024, we updated the PULS framework based on the latest development in terms of the new IPSAS standards. So the number of dimensions increased from 102 to 207, for instance. And in case of Georgia, we also had 7 dimensions scored as not applicable, even though at the beginning the number was much higher, but then we had to find a way to reduce that number. In terms of the overall score from conceptual perspective, it was B, and from actual implementation score was C, which is a very strong results and consistent with the ongoing work done by our Georgian Ministry of Finance colleagues. At the pillar level, you can see a little bit the distribution of the scores. In most of the cases and most of the countries, the pillar 1 and conceptual framework has the highest score, usually at least at the conceptual level. I also very appreciated with our Georgian colleagues that they were very honest in terms of assessing the conceptual implementation and the actual implementation. And we can see that in many cases, the actual implementation falls slightly behind the conceptual or availability of the regulatory framework on the different aspects of public sector accounting framework. Probably the lowest score, not only in Georgia, same in Tajikistan, in Ukraine, Armenia, across the countries, is a pillar 2, which has to do mainly with the financial assets and financial instruments. Those who work on that standard know that it's a very complex standard, actually a series of standards. So probably, and some of them, they are not applicable. Even though they should be, but in practice, they're still not applicable. So this sometimes punish the overall score. Georgia scored very well, though, in the pillars 3, 5, and 6, which has to do with non-financial assets and liabilities, financial reporting and consolidation, and the reform prerequisites and capacity for implementation of the future reforms. In Tajikistan, even though there is only 2 dimensions scored an A, the situation was a little bit different, and we will go there soon. But I wanted to share with you that in case of Tajikistan, it was quite of unique case because the assessment, it was an external assessment done by colleagues from BDO firm as part of the larger engagement that Arman is working and Bank team is working in Tajikistan. For instance, as a reference, the assessment in Tajikistan was done in 3 months, which is a kind of best practices for us, and hopefully most of the assessment we can stick to this time frame. The expected time frame based on the handbook is 6 months, but in practice, at least for the pilot assessments, the implementation line was a little bit longer. Karen remembers. In terms of the overall conceptual score for Tajikistan is C. So they're trying to be proactive in terms of revising and issuing the new regulation on public sector accounting. However, in terms of implementation, there is still some challenges. And this is why the bank team is working to continue providing support to our Tajikistan Ministry of Finance to improve their public sector accounting system in general. In terms of the score distribution, the situation is a little bit similar. The most affected pillar is again Pillar 2 that has to do with financial instruments. Pillar 4 related to expenses, revenues, and recognition. Pillar 3, non-financial assets, liabilities, and the last pillar on the capacity strengthening and reform prerequisite for implementation. Very briefly on the main changes to the IPSAS online assessment tool. Some of them Vladimir shared with you last year. Some of these have been further revised and updated. So the PULS tool was moved to a new dedicated server, which gives it more privacy, more security, more confidentiality. We continue exploring using the AI functionalities to standardize and enhance the quality of the assessments, concept note, and the reports. There will be a little bit more information on that part. We are introducing assessment comparison and dashboard functionality, which will be helpful a little bit further, and as long as we have more assessment done at regional and global level. A new functionality to go back in terms of the step and processes of the assessments. Sometimes we realize we need to change the score, or there was a typo, there was a mistake. So now the assessment leader can go to the previous phase of the assessment without requesting the IT help to do that. There was some improvement in terms of the technical support and issue reporting function. So we tried to habilitate and make it more automatic through implementation of notification system and a series of templates which will allow to report any technical issues or glitches that the assessment team or peer reviewers would face. Now it's possible also to download a full list of all assessment users with their email, name, and picture if available. We continue applying patches and improving the overall security of the system, and the regular backups of database and related files are also done on regular basis. In terms of the use of artificial intelligence, the main functionality we are introducing is the generation of the zero draft of the concept note, which of course still need to be reviewed by actual person, by the assessment leader, but the system at least could help to fill out some of the sections of the concept note. Particular emphasis was paid to the verification of compliance of the concept note and the financial report. So the system would guide the assessor in suggesting if some wording should be changed, if something is missing in terms of the compliance with the PULS framework. And specifically on the dimension level, there is a possibility to use AI to validate the provided responses. The system would suggest a revised wording and the revised scores as needed based on the methodology, and the assessor will have a choice to accept or reject the suggestion. In terms of the next steps, we were just discussing with Arman what we can do as part of the PULSAR program, what could be done as part of more global level engagement or through the other similar programs. So probably the first step is to start working on the translation, which was always part of the PULS project. And when we talk about translation, and not just translate the framework, which could be done through AI with some proofreading, but we're talking about also the inner translation of the tool itself. So when you would log into the system, you would have choice to choose a different language. For now, we are focusing on French, Spanish, and Russian. This is mainly because of the possibility interested from other countries from different regions to start using the methodology. In one of immediate examples could be the Bahamas, in case you want to organize a study tour or a mission to exchange experience with our colleagues from Bahamas. We would be happy to organize that, maybe. The other things that we are suggesting, and that could be done jointly with our climate change colleagues, is to introduce a model on sustainability reporting for public sector. Of course, we know that the first standard will be published and, well, approved in December of this year. But since we were discussing with some colleagues in the bank and beyond, that it would be good to have a straightforward, simplified version of assessment of the readiness, country readiness for implementation of sustainability in public sector. So there will be probably, again, two types of indicators. First, technical indicators linked to the IPSAS board SRS, and a couple of indicators on the overall institutional capacity and system-related and other elements that need to be placed before the sustainability reporting could be implemented. The upcoming assessment, Nesret already mentioned Kosovo, and also colleagues from Inter-American Development Bank with support from Andreas Bergman reach out to us to see if we can conduct the PULS assessment in Bahamas. So I will keep you posted, and hopefully next year we can share the results of these two assessments with you. Thank you very much.
Thank you, Dmitry. Any questions to Dmitry? The good thing is, as you can see, we are advancing the PULS tool, and there is a broader demand for PULS assessment. And our Moldovan colleagues, they also initially for under PULSAR program, country level, they ask for a PULS assessment, but just we expect it for elections, and after elections, we expect to be reconfirmed by Moldova. So this is where PULS is going, and using AI for report writing, and now also planning for incorporating the IPSAS SRS sustainability reporting standard, disclosure standard will also be, we plan to incorporate. So it will be fully compliant with IPSAS and all the developments as a single reference platform. I think it was quite a heavy day. Let's just applaud to our panelists for a very good update from the countries and the work they do on the program level. It's very heavy day, a lot of discussion, a lot of panel, a lot of debates. So we have much more to come for the next 2 days. Now is the time just to rest a bit.